This is a currency and bond-driven market right now.
The market currently is already pricing in rate cuts next year. That might just be way too soon.
We are heading for some kind of a financial accident.
The Goldilocks outcome is now off the table.
I would be very, very surprised if we went into a new bull market anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Have you seen that euro? Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative about 0.75% on the S&P. TK euro dollar, it's basically there at parity.
There's so much more going on, John. What we're going to do here is go beyond parity, folks. Jordan Rochester and Stephen Englander will join us. And flat out, John, this is one of the most historic days in 20 years.
And this is the craziest headline I've probably read so far this summer. Heathrow Airport asking airlines to stop selling summer tickets. TK, there's a headline I'm not sure we expected to read a couple of years ago.
Yeah, afterthoughts on our way over there right now to buy stuff on Carnaby Street. I mean, John, what this comes down to is the gyrations off the pandemic, whether it was the re-lockdown we saw yesterday in China and Macau or Shanghai. But what we need to do is explain to global Wall Street the linkages, the correlations right now are off the chart. It's truly jump condition Tuesday where EM gives way, along with the silliness over euro parity.
Grappling with a supply-constrained economy over in Europe, Bramo, and an energy crisis, let's just call it that people think can get worse.
Well, that was my immediate reaction when I saw this headline. Is it an effort to conserve diesel, to conserve gas and energy, or is this what you said, John, which is basically they don't have the people to staff the place? And how much does this really show the dueling nature of what we're talking about, which is an imposed recession, an imposed downturn, an imposed contraction that we're seeing being speculated about in Germany in order to avoid an energy crisis? This is a new era that's leading to those jump conditions Tom talks about.
TK, this FX stuff is problematic, and I looked at Japan for that. To see a joint statement from Yellen this morning and Japan's finance minister, the Secretary of the Treasury, essentially ruling out FX intervention anytime soon. And Tom, the problem that I think a lot of the currency markets have at the moment is that for a long, long time, these countries have been trying to engineer currency weakness, and all of a sudden it's unwanted. And in Europe, it's unwanted in a massive way.
Well, yeah, what's important here, and this goes back to Folkets Landau and the invasion by Putin, is the assumption of a strong dollar. And I'm going to be very straightforward. As we learned yesterday, John, it is about hoarding of foreigners in cash using U.S. dollars. John, on the energy issue you and Lisa were talking about, let's go to Europe. Rotterdam coal up 530% off a moving average study. And over in Australia, Newcastle, which is not near Perth, Newcastle up 470%. Part of this energy crisis is ESG is dead.
I will not ask you to repeat that accent. And many people agree with you, Tom, on the ESG front. A real reality check over the last 12 months. And Lisa, I think the difficulty you have forecasting the euro right now, if you're forecasting foreign exchange, particularly euro dollar, specifically the euro, you've got to make a commodity call. And if you're making a commodity call in Europe right now, you've got to make a political call. You've got to somehow get into the mind of one man in Russia, in the Kremlin, Lisa, and forecast the decision by him later this winter on gas supply into Europe.
No one can do it, which is why that risk premium is something that is going to stick for a longer period of time, that will be something people charge in terms of a weaker euro just because of such a dramatic lack of certainty and lack of consistency with respect to who's making these decisions.
Let's whip through this price action for you. We are lower. We're negative 0.7% on the S&P. On the Nasdaq 100, we're down 0.6%. Yields are in again. They were down big time yesterday, again this morning, by 7 or 8 basis points on a 10-year to 291.70. Bramo can't take a rise off it. Euro dollar 100.17. Lisa, negative 0.2%.
Okay, it's basically at parity, and for all intents and purposes this morning, it's been flirting with that level. But this really highlights the nature of the energy crisis, as you were pointing out earlier, which is the reason why I'm so focused on 7 a.m., the OPEC monthly oil report coming out. This comes after Fatih Birol of the IEA said that there is the potential for a global energy crisis that we have not seen before because of some of the constraints around Russia. I want to hear about what people plan to do about it, because frankly, I tried to get my head around some of the caps on Russian oil prices over the past week, and I'm left sort of wanting in terms of details of how this is exactly going to work or what other options there could be on the table. At 12:30 p.m., Richmond Fed President President Tom Barkin is speaking at a lunch hosted by the Rotary Club of Charlotte. What is he going to say about how much his decision to raise rates by 75 basis points this month and then again by another 75 basis points possibly in September hinges on tomorrow's CPI print? If they get an 8.8%, as Bloomberg currently expects, does that make them go? If they get a weaker than expected print, how much does that push them away from making such a series of rate hikes? And at 1 p.m., Tom, this is just for you because I know that you're going to be trained on this. U.S. is planning to sell $33 billion of 10-year notes. I am watching to see whether the demand that we have seen over the past couple of sessions continues, especially in light of the steepest and most inverted yield curve of the 2-10 spread going back to 2007. John, this is a more persistent yield curve inversion, and it is getting a lot of people's attention because it is entirely throughout the curve. Not just 2-10s, not just 7-10s, not just 5-10s, but also the 3-month 10-year curve that a lot of people watch very closely.
Getting messy, isn't it? Do you want to talk about the 20-year? Or should we just move on?
Let's move on.
20 years a mess,
yeah,
isn't
20
it?
years a mess.
It's just an absolute mess.
And it's been inverted for a long time.
Lisa, thank you. Thank you very much. This from PepsiCo. Full year organic revenue plus 10%. That's what they see, Tom. The estimate plus 8%. But get used to this headline, TK. We're going to read it a lot through earnings season. They still see a 2 percentage point FX translation headwind.
That's a big
How many
number.
FX translation headwind headlines are we going to be reading through the next few weeks, the next few months?
We're going to see them, and they're going to manage through it. They always do. Everybody makes a big deal about it. I get it. It's accounting reality. Earnings a little less, cash flow a little less, et cetera. But the fact is, the corporations, the multinationals, they'll just manage through it. That's what they do.
Let's manage through things right now with Greg Battle, the US head of equity and derivative strategy at BNP Paribas. Greg, let's start here. Just how bad are things going to get in Europe?
Well, I think that the recent price action we've seen in the FX markets, the inversions that we've seen in the yield curves, it's really pointing to more recessionary price action. I think the outlook for what happens with gas supply, whether we see gas rationing, is going to be a huge swing factor as to whether or not whether we do have a sharp contraction in Europe.
Greg, in the equity market, the question a lot of people have is the value of cash here. There's a real worry. VIX 2709, maybe the VIX almost feels 30 again now. What's the value of going to cash versus finding the right spot in equities?
Well, I think the thing that we have to try and do is to trade off this volatility that we see persistently in the equity market versus the cost of carrying an allocation to cash, which is effectively the price of inflation. So we're going to have this CPI print later this week, which could well be the peak in the cycle, but a very high number. So there's a large opportunity cost of going into cash. But so far this year, it has been something that has paid off in these turbulent markets.
And meanwhile, the safety trades in equities are being turned on their heads somewhat. We've seen oil stocks, for example, come out a bit as we see oil prices go down on the fears of a lack of demand. How much do you think this is a head fake, and how much is this a real shift in terms of the leadership that we've seen so far from commodities?
Yeah, thank you, Lisa. I think it's a great question. We've seen some real changes in leadership over the last weeks in equities. So at the start of this year, we've really seen the tech names underperform, and it's been a multiple compression story. We think as we move through the earnings season and through the next couple of quarters, the market's going to be far less focused on what rates are doing and how that's compressing valuations. Yeah. And it's more going to be an earnings story. So something like the energy sector, I do think is uniquely interesting. You know, you have to be cautious of the potential for demand destruction weighing on the oil price. But we have had years of low capex investments from some of these oil names. We have very low single-digit P multiple valuations for these oil stocks. So we think there is some asymmetry there. And if we can see crude stay within the kind of range that it's been in recently, then we think there's actually potential to still see upgrades to earnings forecasts for the oil names. And against a backdrop where we're seeing downgrades pretty much everywhere else in the market, I think that makes it a slightly unique sector at this point in the cycle.
Greg, very quickly here, Mohammed El-Arian is out with a beautiful phrase which captures the jump conditions of the moment, plural, and that is little fires everywhere. That perfectly describes what's on my Bloomberg screen this morning. How do you adapt in equities when you see the little fires in FX and in CDS and in debt?
Well, I think undoubtedly we have to take these warning signals cumulatively. And I think indeed equity markets have digested this. We've described the price action that we've seen this year already as recessionary. We've had an absolutely massive valuation compression this year, and we've entered an equity bear market at a time when things like the labor market data is still very strong. The PMIs, certainly in the US, haven't really rolled over. So I think it's fair to say that the US equity market is part of that story. It's already signaling that things are going to get worse. The question is how much worse and how quickly.
Greg, you flying back to London anytime soon?
I am, and the conversation you were having earlier is making me a little nervous about my connection.
Me too. Greg Battle of BNP Paribas. Greg, great to catch up, sir. If you're just tuning in on TV and radio, here's the headline. London's Heathrow said it would ask airlines to stop selling tickets for summer travel. There's going to be a cap, Tom, a cap on daily passengers of 100,000 through September 11th, according to a statement delivered just moments ago. 100,000. What we understand from the latest travel forecast, the airport would have had to handle as many as 104,000 passengers a day over the summer. And Tom, this just comes down to staffing. I'm just going to read some of these quotes. The new recruits were not up to full speed. Certain functions, including ground handlers for baggage, were, quote, significantly under-resourced. There is a labour problem. And we know, Tom, and we know we are supply constrained in a material way, particularly in this industry.
How do you solve the labour problem, John? It's real simple. Pay them more. They will come out of the woodwork.
What if they need more training, Tom? What if this is just about a duration issue?
How long does it take to train a baggage guy?
It can take weeks and it can take months for certain elements of airport staff because of security issues as well, Tom. So to ramp up capacity, to ramp up staffing in certain places, certain industries, it's really, really difficult.
So what do we do? Go through Copenhagen? Do we go through Madrid? I mean, you tell me.
Well, 100,000, Lisa, how much of a problem are we going to see relative to what they forecast?
Well, this is fascinating for people who are traveling through Heathrow, as Tom indicates, but it also is a bigger issue, right? Which is that basically we cannot increase supplies and we cannot increase capacity simply because of the staffing dissonance, and it is difficult to solve. We've heard it from everybody. This is not just a simple pay them more, bring in more people, because the turnover has been dramatic.
I think for a lot of people, they've already lined up outside certain terminals at Heathrow, trying to get their tickets and get through security. I think they're probably sitting here thinking, about time. I mean, seriously, where was this call weeks ago, months ago, when these tickets were sold? Futures negative 0.6% on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The euro is moving even closer to parity with the US dollar. It hit a 2-decade low earlier today. Risk aversion has led to a broad rally in the greenback. Meanwhile, concern over a recession is weighing on the outlook for the euro area. And the price of oil is falling again today. A COVID resurgence in China is adding to concerns about a global economic slowdown. Meanwhile, the White House says OPEC has room to raise production if President Biden's upcoming trip to the Middle East yields any agreements. One of the president's stops will be in Saudi Arabia. The Conservative Party in the UK wants to narrow a wide field of contenders to be Britain's next Prime Minister. It will require candidates to have the initial support of 20 Tory members of Parliament. Nominations will open and close today, with the first ballot to be held on Wednesday. The party's new leader, and therefore the UK's next Prime Minister, will be announced September the 5th. And London Heathrow's airport is taking another step to put an end to the summer travel chaos. It's asked airlines to quit selling tickets for this summer. Heathrow has imposed a capacity cap of 100,000 daily departing passengers until September the 11th. Staff shortages have led to long security lines and misplaced luggage. And it is the first time human beings have seen a distant galaxy cluster as it appeared more than 4 billion years ago in such vivid detail. President Biden unveiled one of the first full-color images from the James Webb Space Telescope. The telescope was sent into orbit roughly 1 million miles from Earth late last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Real economy is quite strong in America right now. Inflation is our challenge. The Fed is appropriately taking action. The administration is doing all that we can do. And I think, and a strong dollar is as it is, which I am not worried about.
I'm sure they're not worried about it at all right now. Gina Raimondo, the US Commerce Secretary, that's part of the operation, isn't it, Tom? Get inflation down, a stronger dollar.
Yeah.
That's going to help.
It's going to help to a point, and then it goes the other way. It's called ambiguity. George Saravelis of Deutsche Bank Publishing moments ago, I believe, with us yesterday, John, and I love, he's on script with you, me, and Lisa. Euro parity, it's not significant, but what is significant is a lack of liquidity out there due to this global slowdown we're looking at. And John, excuse me, again, you see that over in the yield space.
We've had a 12% move on euro dollar this year. It's already been a massive move. We're just going to run through the market action for you this morning.
Please.
If you're just tuning in, we're down about 0.6% on the S&P. On the Nasdaq 100, we are down 0.4%. What we see in the bond market going into CPI tomorrow is a real bit into treasuries. Yields lower again by 7 basis points, Tom, on a 10-year 292.07. Yeah. And those of you following the chart, euro dollar 100.14. We're negative 0.25%, Tom.
Let us digress to what we cannot imagine. Imagine standing there last night with 1 grain of sand outside the beach house up on Cape Cod, let's say, and you put the grain of sand up in the sky, and that is the image of what the James Webb Telescope has done. I know it's a science diversion. I know no one cares, but the light from that image, and on radio it is that spectacular image of galaxies, is 13 billion years old. Joe Matthew knows what it's like to look at the images of a Washington where light travels at the speed of molasses, and he joins us.
I thought you were going to say looking at people who are 13
that is quite a wind-up.
It was quite a wind-up because, geez, do we wish Washington ran like James Webb and the good people at NASA?
Well, let's remember, sometimes the government does cool stuff. This is a NASA product here. That is a government agency that generated something as incredible, and not anyone seemed to notice it yesterday.
How shut down is your city, Joe? It's 92 degrees. We're looking at NASA pictures out into the middle of nowhere. Let's look into the interior of Washington. What's the level of shutdown in Washington?
Well, lawmakers are coming back. House lawmakers today, Senate back yesterday. We've got the January 6th committee hearing today. And yeah, it's going to be about 96 degrees with extreme weather thunderstorms predicted this afternoon. Lots of symbolism hanging over this White House as the president gets ready to head overseas. Shut down, not so much. It will really feel that way next month, though, which reminds us that lawmakers have, gosh, only about 3 weeks to get a lot of things done before they head home. I won't call it their recess, but to their home district work period next month.
That's a wonderful euphemism. I think that I'm going to head home to my home district work unit over in the Adirondacks. I am wondering, Joe, if we're talking about the main issues, one of them is gas prices, and we have seen them come off just a little bit, but there is a big talking point about capping the price that Russia gets for oil and gas. Does any of this make sense to you when you look at the nuts and bolts of how this plan has to work and getting everybody on board globally?
Boy, be careful. Be careful in ever asking me what makes sense to me, because sometimes we can simply report the facts. It's hard to rationalize what's going on. And that cap has yet to be established, but it will certainly be in the front of President Biden's mind as he heads for Saudi Arabia this week in the hopes of unlocking some extra production. The question, though, is, number one, is there spare capacity, as Saudi Arabia and the UAE suggest, about 3 million barrels a day? And even if we can tap that, what do we do with it when it comes here? The refining bottleneck is a major issue. 95% capacity is where we're running right now. So even if the president scored a big deal, announced a big gusher of oil that was coming, we may not be able to do a lot with it, enough at least to impact prices at the pump.
Is this cabinet basically resigned to getting a beating in the midterm elections coming up because it is so difficult to get some of these base factors down?
I'm not sure. It depends who you ask. They each have their own personalities. You know, Marty Walsh is going to have a different answer than Pete Buttigieg when it comes to that. But now that we're coming up on November, now that we're getting into the second half of the first term, if you will, it is likely that we'll start seeing the revolving door swing a bit more. We did see the communications director, Kate Bedingfield, announce her resignation most recently. So it's difficult to tell. The fact of the matter is, though, if they haven't left yet, they're on board for the midterms, and they're going to be fanning out across the country to try to make the case for this president on the trail.
Joe Matthew, what does Joe Manchin want to get accomplished here? I mean, I get the battles that are going on in that, but I can't get a straight answer on what his goal is to get to the
I don't think Chuck Schumer can either. I think that remains a question. They want to have something to show for this session. And you remember Joe Manchin, laid down the 1.5 trillion and so forth with Build Back Better. It looks like there's going to be a Build Back Better light, if I can keep calling it that. They are moving ahead with a reconciliation bill, but it's getting complicated, Tom. And there's one thing I want you to look out for, and that is the expiration of enhanced subsidies for Obamacare, the Affordable Care Act. They expire at the end of this year. And that reconciliation plan could be the only avenue that Democrats have to revive those or extend those subsidies. Otherwise, we're going to be talking at the end of the year about another mess with millions of people potentially losing their health insurance.
Hey, Joe, we'll be talking in the next hour. Looking forward to it. Joe Matthew there down in Washington, D.C. Just yesterday, we got a full breakdown of Bank of America's credit card spending data, debit card spending data.
Tell me about that.
Really interesting stuff when you look at the gasoline spending. Up another 4% in June, up 20% over the last 5 months or so. And this is starting to take a toll on other categories of consumer spending, including services, according to them. Spending on travel and restaurants fell for the first time since January. Now, you remember what happened in January. It was the Omicron surge, the peak of that, Tom. So month over month, the first decline since January for spending on travel and restaurants. Interesting stuff from B of A yesterday.
And not to link it too tightly, but Gap Stores shows the door to their CEO with tepid sales
I saw the same thing, Tom.
You really wonder, within obvious retail fashion and all that, but just in general, wonder how they're going to do. What am I going to focus on? I've got to focus on the well-done machine of Home Depot. It'll be fascinating to see how Home Depot performs.
You've taken us to housing, Tom. Redfin put out a report yesterday as well. Lisa, I'm sure you saw this one. 60,000 home purchase agreements fell through in June. Almost 15% of homes that went under contract that month. That's the highest percentage since March and April 2020. Now, you can imagine why people were spooked in March and April 2020 and pulled out of closing on houses. But people are spooked. People are spooked and they're getting crimped. Their spending's crimped by what's happening with gas prices too.
They're getting spooked when it comes to the transaction volume of housing. You are seeing in certain regions the prices come down just a touch, but not dramatically. The worry is it is not going to bring rents down quickly enough, that some of these fissures are not going to bleed into lower CPI, lower basic inflation for the average consumer quickly enough to curtail some sort of ongoing tightening and disruption.
Lisa, you've been on top of that story. Looking forward to the coverage of that tomorrow. CPI in America tomorrow, then on to bank earnings in America.
Is Lisa with us tomorrow?
Lisa will be with us over the next couple of days, and then Bramo is on a jet plane.
Oh, that shade.
Flying far away. You're going through Heathrow this weekend.
Yeah, I'm going to travel through Heathrow. Although I think, that was just cancelled.
Futures down 0.5% on the S&P from New York. Good morning to you. This is Bloomberg Surveillance. From New York City this morning, good morning to you. Equities lower by 0.5% on the S&P, and the Nasdaq 100 down by 0.4%. An update from Marko Kolanovic over at JP Morgan. He's gone from max bullish to about 95% max bullish.
Abrupt change.
I'm going to build on that a little bit later. I'll build on that in just a moment. In the bond market, we look like this on 2s, 10s and 30s going into CPI tomorrow. The headline estimate about 8.8% and maybe a little bit higher. We'll build on that with Ian Shepherdson at Pantheon, with yields coming in ahead of CPI. I want to finish on this, though. I know a lot of you are very focused on what's happening with euro dollar. Let's talk about the problems behind the single currency. And it's all about energy. It's all about gas and what happens to energy supplies into the continent through winter. 6, 7, 8, 9, 10, 11, 12 months away. But, Tom, that takes me to growth. And what Goldman did with copper, I think, is worthy of a little bit more attention. Their price target comes down from about 86.50 down to 6,700. Right now, 7,472 on the LME, and we're softer by about 1.5%. Tom, if you're out there looking for a big global growth resurgence in the second half, Goldman's not on board when it comes to copper.
It's drifting away. And when you look, John, at the summation of the coal charts, the copper charts and such, the WTO forecast of 4 or 5 months ago of 2.8% global, we laughed. Guess what?
Yeah.
We're there.
Well, Tom, I've talked about the problems forecast in the euro. You've got to make a forecast on the commodity market. You have to make a forecast on gas. And with that, you've got to make a forecast on what Putin may or may not do. When it comes to copper, you've got to make a call on what happens with lockdowns in China. And that's just as hard, isn't it? Because that comes down to President Xi, how we define success, whether we are reopening or locking down. And the latest evidence out of Shanghai at the moment points towards perhaps more restrictions.
Yeah, we're seeing the restrictions, hospitalizations by one study up 18%, even as deaths stay flat. But John, I do take your point on that. Are you done? Do you have any more FX
I am
for
done.
us?
The only thing, the bottom line, whether it's copper, whether it's the euro, your forecasts are based on the whims of two dictators. You've got to work out what they're going to do.
Yeah, well, we'll have to see. Futures negative 21, the VIX 26.94 out of stick. Right now, quickly on the Heathrow story, a gentleman who is quite good at aviation. He watches Big Jet TV all the time. 777 incoming. Guy Johnson joins us at Heathrow. Guy, what is the distinction of the chaos at Heathrow?
It is getting worse. And while there are different problems in different parts of the world, for instance, United Airlines blames the air traffic control system in the United States as being its problem. Here in Heathrow, we're dealing with a situation where they simply can't train enough staff quickly enough. There is a note that has been published this morning by John Holland Keene. He is the CEO of Heathrow. It starts off, "Dear passengers," and it goes on, Tom, to talk about the arithmetic of what is happening here. They're trying to bring people in. It's a slow process. They're hiring as quickly as they can. Then they're struggling to train the staff as quickly as they can, and they're simply not keeping up with the demand that exists at the moment. So the arithmetic, Tom, goes something like this. Heathrow is now saying that it can deliver 100,000 passengers a day. It can't do any more, and it is now going to cap it. What it is saying is that by its current forecasts, looking at the current forecasts, airlines have booked around 104,000 seats per day in and out of Heathrow. And what they're saying is they can't do that. What they're saying is that there's an excess of 4,000 there. 1,500 of those seats have already been booked. 3,500 haven't. So what Heathrow is saying is, you can't do any more, guys. You're done. We're at the 100,000 limit. We're slightly over it, as a result of which you cannot sell any more seats this summer coming in and out of our airport. This is a huge problem for the airlines. They are obviously trying to rebuild their balance sheets, Tom, as a result of what happened during the pandemic. But capacity constraints, labour market constraints are now a massive factor, and they cannot do it. 100,000 passengers, that's it, we're done.
And Guy, this does not necessarily bode well for the inflationary backdrop, because people will actually be willing, it seems, based on the demand, to pay more for those tickets, and airlines will demand more in order to compensate workers. How much is this an airline-specific story, an airport-specific story, and a broader one in the entire workforce in the United Kingdom?
It's a much broader one, Lisa. Last night, the train drivers voted to go on strike. You've seen other train staff going on strike. You've got barristers on strike. It is across the economy right now. The service sector is definitely feeling it, and feeling it in a really big way. We are short of staff. People have left the labour force. With the UK, you've got the added complication of Brexit in there as well. But even if the airlines wanted to charge more for the seats, Heathrow is saying, you can't have the seats. We're done. You can charge as much as you like for them. You are not allowed to sell them. There is a limit.
A massive question about how much the seats are going to cost leaving from other airports in the UK. What's going to happen there?
Well, you're going to see this obviously move over to other airports. As you say, Gatwick is the most obvious case in point here. Then you get into some of the regional airports. But I remember sharing a taxi a few months ago, John, with somebody who worked at Manchester Airport. They had a huge problem. This is across the board, across the UK. And it is... Different airports have slightly different problems, but it's basically the same issues. It's ground handling staff, it's ticket desk staff. It goes across the board. In the States, there's pilot shortages and other issues, so different regions having different problems, but it is a problem that is going to face the entire industry across this summer. Then you may end up seeing a significant drop-off in demand. And that's the big question that everybody's trying to ask themselves here. When you get into fall, when you get into autumn, what happens? Does that demand drop off? They're trying to ramp up quickly. Then does the demand drop off and leave them high and dry in that situation as well? Exactly the opposite of where they find themselves now. So there's huge problems. If you take a look at the short positions that are being built up in the airline sector right now, John, they are building and building and building.
What a mess. What a mess. Guy, great work, buddy. Looking forward to your coverage a little bit later this morning when Guy Johnson runs you through the European close. TK, go on.
One stop. You can get from Edinburgh to Naples with one stop. It's
Thanks for letting me know.
But,
is that my update for getting to Italy?
Right now.
What Guy just said then, working out the appropriate capacity at some point in the future, is a difficult thing to do. And we've seen that with the retailers over the last couple of years, haven't we?
Forget we're coming out of a once-in-a-lifetime medical crisis that many would say we're still in. Right now, for Global Wall Street, as you are fixated on dollar DXY through 108, the euro, forget about the parity silliness. Euro Swissy popping right down on a 0.98. Is the guy with the single most important concept out there with a major hat tip to David Rosenberg of David Rosenberg Research Toronto. Ian Shepherdson at Pantheon is looking at core inflation. Ian, why should we pay attention to core CPI?
Well, partly because it's the stuff that's not so affected by the pandemic. So a lot of the headline inflation numbers, whether you're looking at rents, which obviously have gone crazy, airline fares, super crazy, hotel room rates, car prices, all of which have been massively distorted by COVID. So the idea of a core number is it looks behind all that noise and says, well, what's really going on in the guts of the inflation story? Because that's what will be there when all this COVID stuff eventually drops away. And what's driving that core story mostly is wage growth. Now, remember this time last year, we were talking about frantic wage growth and a super tight labor market and really getting worried about the idea of a wage price spiral. It spooked the Fed late last year. And now, looking at the same numbers, the picture is really very different. Wage growth has slowed quite a lot, and already that is feeding into smaller month-to-month prints in the core CPI. So it's too early to crack open the champagne, and we've still got too many big distortions to the upside from COVID. But looking behind all that noise and saying, okay, where will we be in 6, 9, 12 months' time? These numbers are really encouraging to me, and I think there's every chance that they continue.
But Ian, to Tom's point, core CPI has lost a little bit of its potency at a time when people are worried about inflation expectations. Even Fed Chair Jay Powell came out and said, look, we can't be too nuanced about this because at the end of the day, it's what people feel every day, and it's happened for long enough that you're starting to see inflation expectations creep up, notwithstanding the data necessarily over the longer term that we got yesterday from the New York Fed. So how do you push back against that yes, core CPI used to be important, but is less so now?
Yeah, I don't buy that for a second. I mean, the thing about expectations is why do we care about inflation expectations? Why do we care when anybody thinks about anything? We care because of the way that it might translate into action. And the action that we care about is higher wage demands. So if you have a situation where headline inflation has shot up, expectations have shot up as well, and as a result of that, people are seeking and are extracting bigger wage increases from their employers, then you've got the danger of a wage price spiral like in the 1970s, which, as we all know, was a horrendous nightmare and took a long time to fix. But there's no sign of that at all, none at all. I mean, you know, wage growth over the last few months has averaged about 4% in the US, so only slightly higher than we saw at the end of the last normal economic cycle, and actually quite a sustainable pace if productivity growth is around 2. So I'm quite happy with that. It was very different a year ago, no question about that. Wage growth was 6.5, and at that point it was very scary. And if it had continued, or heaven forbid, had accelerated further, the Fed would have been in absolute panic mode long before now. But that didn't happen. What's happened instead is that labour supply has picked up, participation has risen, a lot of people have come back into the labour force, wage growth has moderated. You can see that already in the core CPI, and the fear of an expectations-driven spiral is just not justified anymore. It was a risk, but it's not there.
And Ian, as we were just talking about with Guy Johnson over the United Kingdom about Heathrow, there is a concern about the other way. All of these companies building up capacity right now in the face of some of the distortions on the heels of the pandemic, only to be met with a lack of demand very quickly in the next couple of months. How much are you worried, or how much do you expect this sort of disinflationary force from that overcapacity that's being built up right now?
Yeah, this is a big deal. I mean, especially in the goods market, where we can see now inventories in some sectors are way above where they were before COVID. I mean, massively in some cases. So having had a story of a gigantic margin expansion driving up core inflation over the last 18 months, I think the story for the next year is gigantic margin compression from really extraordinary levels, which obviously poses a question for equity investors because of earnings compression. But from the Fed's perspective, from market perspective, what it means is that the pace of disinflation over the next year, I think, is likely to be quite a lot quicker than markets expect, because it's not just about a gradual slowdown and easing of wage pressure. It's about the potential for an absolute collapse in margins. And some margins, you know, car dealers' margins are 3 times higher than they were before the pandemic. There's no way on earth that's remotely sustainable. The only question is just how fast they fall. And if they fall very quickly, you could see core inflation in the US returning to target next spring, easily.
Ian, one final question very quickly here. Pantheon has a unique focus on the Pacific Rim. Are we seeing butterfly effect right now? Are we seeing butterflies flapping abroad as we focus on euro? Are we missing the EM unravel?
I'm not sure unravel. We've had a very tough period in China, that's for sure. But the EM Asia picture is not one of uniform grimness, that's for sure. There's some bright spots there. And certainly some of the China data are improving looking forward. I mean, looking back, we get second quarter GDP numbers this week. They're going to be terrible. But that's, ancient history now. That stretches back to, to April when things were very different. So we are certainly not bullish, but, it's not catastrophic. And some of the forward-looking surveys have certainly popped higher. So that's a relief to everybody else, but only at the margin. Really, the Euro story is about Europe, the US story is about the US primarily.
Ian, awesome to catch up. Enjoyed the research over the weekend. My thanks to you and the whole of the team over at Pantheon Macroeconomics. Ian Shepardson there. And to what Ian was talking about, in certain parts of this market is betting against inflation and betting on slower growth. And Lisa, the perfect pocket of this market to look at in fixed income that captures that is break-evens. Break-evens basically near the lows of the year. And it doesn't really get talked much about.
Yeah, I was looking actually this morning. I'm really glad that you mentioned that at the five-year break-even rates. And this is basically a measure of market expectations for inflation over the next 5 to 10 years at 2%. They're right there at the target. They're basically saying the Fed's going to get there. And as you said, have been trending lower. Basically conviction the Fed's going to get what they want and that there is going to be enough disinflation to get the market there as well.
At what price do they have to
question.
pay to get it there? And that's what this market is figuring out. Futures down 0.6% on the S&P from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg.
The world has never witnessed such a major energy crisis in terms of its depth and its complexity. We might not have seen the worst of it yet.
Fanny B-Roll there, the IEA Executive Director from New York City this morning. Good morning. Futures negative 24. We're down 0.6% on the S&P 500. On the Nasdaq 100, we're down by 0.4%. Yields coming in 7 basis points on a 10-year, 292.25 on 10s. We were down 9 basis points yesterday on the session. So we add to that move lower going into CPI tomorrow. Just want to reflect on the words of the French Finance Minister, the Economy Minister, Bruno Le Maire, Tom, to echo what Fanny B-Roll just said there, that we should probably get ready for a total shutdown of Russian gas supply. And this may well be the most likely event. That's the fear behind some of these moves we see in FX with euro-dollar within striking distance of parity.
And I went through the coal complex today, and you're seeing it, John, not only in the very visible FX and the move to parity, 1.0012 right now, but John, I'm sorry, it's mirrored in what I'm going to call usable commodities, copper, Newcastle coal, Rotterdam coal, AJA, I think, ARA. I mean, there it is. They're moving.
Yeah. The capacity constraints on Heathrow, Tom, I wonder how much more you're going to see that across economies in Europe for different reasons. That was about access to staff, labour. What about energy?
Well, we'll see about energy as well, and maybe that's the next step here. To be honest, Brent crude is relatively quiescent from 124 down to 104. John, some headlines on Spain, which harken back to our conversation with Dr. Boucher the other day. Spain to impose exceptional tax on banks, the Prime Minister says.
Yeah, new tax on banks for 2 years, Tom. I haven't got the details on this bank tax, so when I get them, I'll bring them to you.
In the boom economy, there we go. Right now, Ellen Waldwood is senior fellow at Atlantic Council on oil, on strong dollar, which harkens back to another time and place, and petrodollars. Ellen, what does a strong dollar mean for your oil world?
Yeah, it's, things are quite incredible in oil right now. And as we're seeing, prices are kind of going on a rather almost like a roller coaster up and down. Fears of recession tend to send the prices down because there's a sense that this will reduce demand. But then the next thing you hear is, demand is so strong still. And so then you see prices going up. I think that the news of Heathrow reducing capacity could actually, or putting capacity limits, the idea that could potentially reverberate across other airports could put a damper on travel and jet fuel demand as well.
Is there a linkage of petrodollars to declining oil demand?
That's a really good question. And I think at this point, we're not really seeing a drop in demand. We've looked at gasoline stats. Some weeks we're seeing a drop and other weeks we're seeing an increase. So I think that we have seen some declines in terms of demand destruction, but not a whole lot. There's a lot of pent-up demand. It doesn't seem like the dollar's really affecting demand all that much at this point.
Ellen, which raises a question of when we're going to see a pop in oil prices, given that even Fatih Birol, as we were just hearing from the IEA, came out and said this is a global energy crisis in a sense that we have never seen before in terms of complexity and speed. When do we see that translate into the higher prices that so many people are expecting and that, frankly, you're seeing in the physical market?
It's so interesting because we're seeing a lot of calls for either, oil will either go to $238 a barrel or it could go down to $60 a barrel. And that's a huge margin here. And I do think that it reflects a lot of the uncertainty. And Fatih Birol is correct to call attention to a lot of the issues that we're seeing today. I mean, look at what happened in Sri Lanka. That could be next for many more countries, and not just developing nations, but we could absolutely see fuel crises around the globe. And, part of that is due to historically low investment in fossil fuels. And, that trend is not really reversing itself at any point. And this is precipitating a huge energy crisis.
Ellen, does any part of the capping of energy prices from Russia, or at least the energy prices that they receive, does it make sense to you in terms of its feasibility and a rollout and getting everyone on board? Or is this basically highlighting the lack of tools right now available to really curtail the crisis that people are talking about?
Yeah, I just don't see how imposing a cap on Russian oil prices is at all feasible because, say you even get India and China, which are the biggest buyers of Russian crude right now, you say to them, okay, only pay this amount for Russian crude. And the idea is that India and China will want to pay less. Of course they want to pay less, but will the Russians want to sell them for less? Russia's holding the cards right now because if India and China want their oil, they can say, sorry, we're not going to sell it for, $40 under the benchmark. We're offering you a $20 discount. And are India and China really going to say no? Are they going to risk, especially India, having a fuel crisis in their country just because the West is saying, we want you to cap the price of Russian oil so that, it'll hurt Putin in his war against Ukraine? They're probably looking at saying, Ukraine what?
Ellen, you just mentioned Sri Lanka, and I'm very curious about the contagion effect here. When a given poorer country, beleaguered by high oil prices, provides subsidies domestically, where do they get that money? Do they issue debt, or is it a bailout from the IMF?
I'm guessing that they first issue debt and then they're hoping for a bailout from the IMF. And if that's not, coming, then they're going to see some serious problems. And we're seeing not just, developing countries do this, but we're seeing it in more developed countries as well, offering these kind of subsidies or trying to subsidize or cap energy prices. And in some cases, they're saying to the utilities, you can't charge more than X. Well, if the utilities have to pay more than X for their fuel, then that's just going to put the utilities in a bankruptcy situation and likely cause them to be nationalized. And then the government's going to take that debt and so on and so forth. So they're not really solving the problem. They're just kind of kicking it to other people or to other entities.
Ellen Wald of the Atlantic Council. Ellen, thank you. Thank you so much. And TK, we've got a real problem in Europe, to say the least, and it could get a whole lot worse year end.
Oh, we do. In oil, there, Ellen Wald single-handedly moving the market, John. Brent crude from near 105 now, absolutely cratering. Can I get an intraday up, Qantas, of Brent crude 102.91 right now? It's simple, John. Oil in free fall.
We're calling our Australian producer Qantas again this morning.
Well, we are. It's a famous family Indian name. It's, a little bit Aborigine, although it's more of an Eastern phrase than a Western phrase like you'd see out at Perth.
You dig yourself out of that hole in a
I will,
moment.
thank you.
Lisa, you've talked about betting against inflation, betting on slower growth. Crude down 4%.
At what point does this translate into what we're actually seeing on the ground? And Ellen really highlighted that because we're not seeing demand go down all that much, as evidenced by the enforced Heathrow ban and enough people coming on, as many people as want to come to the airport.
We're seeing equities go down. We're down 0.7% on S&P 500 futures. Coming up, Anna Han of Wells Fargo from New York. This is Bloomberg.
This is a currency and bond-driven market right now.
Market currently is already pricing in rate cuts next year. That might just be way too soon.
We are heading for some kind of a financial accident.
The Goldilocks outcome is now off the table.
I would be very, very surprised if we went into a new bull market anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a market this morning from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down 0.8%. TK crude breaking down by 4.5%, and a sizable bid again into the Treasury market.
We like to avoid inflammatory comments, but there it is, John. In the last 20 minutes, plunge is the operative term for Brent crude, a 102 level, West Texas under 100. But it's more than that, John. It's a correlation's over. And things are tightly correlated this morning in that the 210 spread, good morning, Priya Misra, with that shocking 50 basis point inversion call. We just printed a negative 10 basis points. Historically, back to the Volcker era, John, that's a big deal.
Down 8 basis points on a 10-year, 291. And Tom, this is happening. Treasury yields lower yesterday, again this morning. This is happening going into CPI tomorrow.
We're going to talk about it with Anna Han here, and, she and I will get mathy on us about tail risk and that. But the tail risks are adjusting this morning, John, and what's so important on the Bloomberg screen on the launch pad, the correlative nature of this is extremely different than a week ago.
Lisa, Europe, we have a problem.
And it definitely is hinged on what's going on with the oil markets, but also this idea that you are coming out of a pandemic to a new crisis, and how do you adjust? And I keep going back to this Heathrow story because it's both an oil story and it's also an economic growth story. How much do you have to curtail growth, curtail economic momentum because of a lack of staff and because of high energy prices?
A supply side story. If you're just tuning in on TV and radio, Heathrow in the last hour announcing a passenger cap through the airport, limiting daily traffic to 100,000 people through September 11th. And Tom, it comes down to getting the new recruits through the training, through security clearance, onboarding them, and this stuff takes a while.
Let's remember, John, that, most of us are traveling fancy class. There's some real agony out there, and I would suggest that this is about individual stories that Heathrow has confronted where they said, this can't happen on our watch.
Should have seen Lisa's face then. Speak for yourself. Big shrug from Bramo. Speak for yourself.
I'm sorry. After being in, most of us are traveling in fancy class. I don't know if I would agree with that statement, but I do think that this is something very real, focusing on everyone from the front to the back of the
Stop
cabin.
selling tickets is the message from Heathrow Airport to the airlines this morning. That's a supply side story. Lisa, you wonder if this extends to other parts of the economy. Not for America so much, but for Europe as we get deeper through the summer and deeper towards a long, long winter, perhaps, for this European economy.
Yeah, and you were grappling with the same questions that I was. What does this do to price? If you artificially constrain the supply that you have of tickets, then does the price go up? Does the demand persist? Or do you start to see a sort of crash where people aren't getting employed and they can't go and they buy tickets? I mean, at what point does this even out? And how does it do that without causing an even bigger price shock before the fall?
Lots still to come this week. We've got CPI tomorrow, bank earnings on Thursday, Mitch on Friday, retail sales. Take your pick. Futures are down. We're lower by 0.75% on the S&P. On the Nasdaq 100, we're down by 0.5%. We've talked about that move in treasuries. Yields down 8 basis points. That move in crude, WTI negative 5 percentage points. And euro dollar, a bounce off parity. Lisa, back to 1.00. 2.2. A euro that's negative 0.2%.
Yeah, and how much does this really hinge on oil and gas prices? And perhaps this is a bit trading in tandem a little bit. And again, I'm totally speculating, but with the price of oil and gas, if there is a concern that higher oil and gas prices are going to lead to a more significant issue for the euro, especially ahead of what we expect from a potential decision from Russia on gas supplies. Today on the oil market, we do get any minute now the OPEC monthly oil market report. How much they talk about the supply and demand dynamic actually confirming what we're seeing in the market, which is prices below $100 a barrel on WTI and above at 101.81 if you look at Brent. We'll be parsing through that. Also at 12:30 p.m., Richmond Fed President Tom Barkin will be giving a speech. How much does he talk about what his threshold is in terms of the CPI numbers that come out tomorrow in order to go 75 basis points, not only this month, but also in September, versus perhaps not the most data point to watch, most important one to watch, and instead look forward to the University of Michigan inflation expectations that we get on Friday. And at 1 p.m., the U.S. is selling $33 billion of 10-year notes. John, I want to understand how much this demand into the Treasury market, particularly the longer end, persists, especially as you were noting, we're seeing a real collapse in the yield curve. It's now negative 10. It's the most negative, the most inverted, going back to 2007.
Unreal moves. Bramo, thank you. Crude, a break of 100 on WTI, back to 99. We're down by 4.9%. Let's call it negative 5, Tom. Brent crude down by 4.7. We're at 102.
Well, yeah, we are. And you mentioned Brent crude, but I would go back to currencies here as a litmus paper of the system, John, as you mentioned, tied into commodities this morning. And I'm sorry, it is jump condition Tuesday. I mentioned it before. These EM currencies, John, I'm getting two opinions here. One is it doesn't matter. And the other is, oh, yeah, look at that. Whether it's Philippine, Thai baht, on and on. Mexican peso getting out near 21. I'm sorry, EM is moving with strong dollar.
Tweet of the morning from Sam Rowe on Euro Dollar. Add on Twitter. Lisa, big win for travellers who are terrible at maths. Euro dollar parity. That's brilliant. That's brilliant.
Yeah, it is brilliant, especially if you look at some of the airline tickets and also all the
if you can buy
costs.
one now. If you can
Exactly.
buy one. If you're trying to go through Heathrow to the continent, of course. Anna Han joining us now, equity strategist at Wells Fargo Securities. Anna, this volatility, this mess, whatever you want to call it, do we need to get comfortable, get used to it? Is it going to stick with us for a while?
Well, I don't know if you can say comfortable, but we do think it's going to stick around, John. I think a lot of the volatility, we're going to continue to see somewhat of a outlier moves on the day. Aggressive rips up, aggressive drops down, and that's going to probably persist until we really see a sign from the Fed that they're easing off the gas pedal in terms of their hiking schedule.
Anna, your note is brilliant. It goes all Nassim Taleb, where you say, forget about the probability distribution, forget about the center tendency of kurtosis and such. Look at the tails, look at the tails. What does the left tail, the sweat of the left tail, the fear of the left tail, what's it look like right now?
Well, we would put it in context of really what sort of investment style we're thinking about. At the left tail, we're thinking about what have been the worst performers. What is that low momentum basket really signaling? And we have this kind of stress scenario, and what looks to be for us, base case of recession. You've heard it time and again, base case, base case. What's driving that? You're seeing these really poor performers be the broken stories here. And when you have that situation, we think that can persist. So to us, we're advising clients, avoid that low momentum basket. Don't go bottom fishing here. And also avoid the high risk basket and lean more towards that low volatility if you're worried about that recession. That's at least in the investment styles. But you also have to think of this in context of inflation. What are the potential drivers that might bring inflation off the boil? What are the extreme cases? And we don't see those extreme cases really relieving us of a CPI print below 8.5 for the rest of this year.
Inflation has been a story that a lot of people have been talking about and obsessing over for most of the year, but now it's the strong dollar and what that does to the S&P, to companies that derive about 30% of their revenues from overseas. How much of that has been baked in, and how much do you expect that to be really a headwind during this earnings season for what equity valuations do?
Well, Lisa, I don't think it's fully really baked in. Now, I wish I could pinpoint and put a number on it for you, but you bring up a great point. The dollar is strengthening, and that strengthening is coming from the different pace in which we are tightening monetary policy versus countries in comparison. And what that does to earnings and already earnings and margins that are under pressure, it's going to add another weight to the U.S. corporate earnings season. And I think that in itself has caused some of that volatility we're talking about. People are worried, can we continue to grow earnings at the pace at which people are hoping for in what looks to be a slowing GDP growth, a weakening consumer? And that growth is going to be really what drives confidence in equities and really what dictates the direction for the rest of the year.
Anna, the cause of a lot of this has been the energy industry and the price of crude, the price of energy, the price of gas. Do they become the victim of the solution? Can I be long those names into year end if I'm expecting that kind of GDP deceleration?
Well, I think there are ways to be exposed to the energy markets and play that carefully. But for us, we think on a broad scale, looking at oil and commodities, they may be peaking here. Now, that doesn't mean that they're going to be rolling over quickly or rolling over strong enough that CPI comes down aggressively. But we do think that in many instances and cases that we may be seeing the top here. And another aspect of that, and where we might see part of that being hinted at, is you look at how much the market believes that the impact of energy has on CPI might be reduced as you look at break-evens. You see break-evens rolling off from what had been above 300 basis points now down to maybe 370, 230, excuse me, 230 basis points. Now that's telling you that it's starting to weaken as an impact, and that's where we're getting our signal that maybe oil and commodities really are reaching their peak.
Anna, awesome stuff, as always. Anna Han there of Wells Fargo Securities, thank you. Lisa, building on what we've been talking about over the last 60 minutes this morning.
Yeah, basically that you're seeing longer-term inflation expectations come down and even near-term ones. If you take a look over the next 5 years, how much is that bleeding into this belief that perhaps oil has already peaked, at least, or is near its peak, because you're going to see a decline in demand commensurate with any potential decline that we get in supplies?
I promised you I'd bring you the JP Morgan update from Marko Kolanovic over in the investment bank. He's gone from max bullish to kind of max bullish. We reduced the weight of corporate bonds and increased the weight of government bonds in our model portfolio. Our model portfolio's pro-risk stance refocuses on equities and commodities, with a credit underweight serving as a partial hedge in an adverse scenario. Tom, I went through the note yesterday afternoon. He is still singing a super bullish tune into year end.
He's got some company as well. It's been a remarkably gloomy week, but there's some people out there saying use this as an opportunity.
We'll catch up with Jim Paulson of the Luthold Whedon Capital Group in just a moment. Futures negative 0.7% on the S&P, yields lower by 8 basis points, and crude breaking down to 99. We're down 5%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The price of oil is falling again today. A COVID resurgence in China is adding to concerns about a global economic slowdown. Meanwhile, the White House says OPEC has room to raise production if President Biden's upcoming trip to the Middle East yields any agreements. One of the president's stops will be in Saudi Arabia. The Conservative Party wants to narrow a wide field of contenders to be Britain's next Prime Minister. It will require candidates to have the initial support of 20 Tory members of Parliament. Nominations will open and close today, with the first ballot to be held on Wednesday. The party's new leader, and therefore the UK's next Prime Minister, will be announced September the 5th. London's Heathrow Airport is moving to limit the recent travel chaos. It's asking airlines to stop selling tickets for summer travel. The biggest airport in the UK will limit daily passenger traffic to 100,000 people through September the 11th. Heathrow is scrambling to hire more staff and says new recruits aren't yet up to speed. And Peloton is taking one of the most dramatic steps yet to simplify operations and reduce costs. The company will quit building exercise bikes and treadmills at its own factories. Partners will now handle manufacturing. Peloton is making the change after several months of turmoil. The company cut nearly 3,000 employees earlier this year, and shares are down 75% in 2022. And it's the first time human beings have seen a distant galaxy cluster as it appeared more than 4 billion years ago in such vivid detail. President Biden unveiled one of the first full-color images from the James Webb Space Telescope. The telescope was sent into orbit roughly 1 million miles from Earth late last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think that ultimately the price of oil or the Fed or maybe the strong dollar will lead us into a recession. And when the recession hits, which will be a 2023 event when it hits, not 2022, that the market will find the bottom somewhere between 35 and 40% below its peak of 4,800.
Really thoughtful stuff, and great to hear from Leon Cooperman there, the chairman and CEO of the Amiga Family Office from New York City this morning. Good morning with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Here's the price action. We're down 0.7% on the S&P. We are negative 0.33% on the Nasdaq 100. Yields are travelling lower again, down by 8 basis points to 291.33. Crude with a 99 handle, down by 4.5%. Everywhere you look, there's a headline right now. Euro dollar approaching parity, bouncing back 100.40, now unchanged on the session on the euro. The latest report out of OPEC, Tom, the first oil market outlook for 2023. Grant Smith here at Bloomberg writing this one up for us. No relief for squeezed consumers. More crude needed from the group, even though most members are already pumping flat out. OPEC expecting global oil demand growth to exceed the increase in supplies by 1 million barrels a day next year.
Not necessarily, John, in order. Well, let's go through it right now before we get to Joe Matthew. We've got fears in Macau and Shanghai, variant 5, I think it is, shut down. We've got the horrific story in Europe with nat gas, coal through the moon, ideas of German slowdown, CZEW this morning. And then we just got a war still going on in Ukraine.
Yeah.
And I mean, the stew of this gets you to a point of crisis. How far are we from that?
China's underplayed this morning, Tom. I think it has been over the last few days.
48 hours, yeah.
As well.
Yeah.
Clearly, we're facing the prospect of increased restrictions across the country again, and clearly the commodity market is picking up on that. And we talked about Marko Kolanovic over at JP Morgan. If you read through his latest note, what he's looking for in the second half is a big rebound, not just in the market, but for global growth potentially too, led by China. China's a big issue in a lot of people's outlooks going into year-end, Tom.
Very quickly, as we talk of EM this morning, the JP Morgan EM FX index, which is a very, very solid index, in the last 10 years has weakened by 47%. That's just a stunning statistic. Of course, much of that recently. Joe Matthew knows this. He does Sound On Bloomberg Radio, required listen on a really good conversation each and every day. And he joins us this morning. I believe, Joe, it's Tuesday. That's about the only thing I can get my hands around this morning. The president awaits Riyadh. How much will Riyadh be about oil talk?
Boy, it depends who you ask. The White House has been really trying to tamp this down. They say it's more of a trip about security.
Exactly.
And, of course, the president wrote to that in his op-ed. The fact of the matter is, look, everybody knows that the president needs to get more oil pumped here, whether or not it will actually lower prices at the pump. But there is a different strategy here. So he doesn't look like he's going hat in hand, first of all, to Saudi Arabia. He's going to be asking OPEC producers as a whole to try to do their part and pump more. But if you think back to the Abraham Accords here and the fact that Israel has not normalized relations with Saudi Arabia, I think the White House, the president here, sees an opportunity. That's what they're going to try to strike as he becomes the first U.S. president to fly from Israel to Jeddah, from Israel to Saudi Arabia. There might be some talk about, and it could be incremental, but might be some talk about bringing Saudi Arabia into the fold there. And it means a lot more as we see Vladimir Putin now preparing a visit to Iran. There are a lot of different layers here. It's a very complicated trip from Israel to Saudi Arabia, and oil may only be part of the equation.
What is his best outcome, bringing that clear discussion, Joe, back to domestic politics?
Well, it has to do with refining capacity, right? If the president of the United States says, yeah, okay, look, we got more oil, but if the prices don't come down at the pump, then there's not much of a point to that, of course. Now, on the other hand, from a diplomatic standpoint, from a peace a global peace standpoint, a security standpoint, sure, that would be an amazing story to tell, bringing the Israelis and the Saudis together, but it may not impact people's lives here in America in time for November.
Joe, when you talk about November, there was a poll yesterday out by the New York Times, Siena College, that found that 64% of Democrats want Joe Biden to step aside and let another candidate run for the Democratic ticket. Has he talked about this privately? What are you hearing in terms of who the frontrunner would be to take his spot?
Well, there isn't one, and that's why they're not talking about this too much. I don't think Joe Biden likes this conversation. Although, you know, maybe when he wakes up in the morning, he thinks, God, I hope this is the only term. But let's keep in mind that the New York Times actually ran numbers on the Republican side as well and show that Ron DeSantis, the governor of Florida, is actually running a pretty good challenge to Donald Trump as a potential candidate in 2024 here. Look, it's really early to be running these numbers. And when you think about it from a generic polling standpoint, you put Joe Biden up against an unnamed Republican, you're going to get one number. If you name Donald Trump, Joe Biden frequently leads those polls. That's also because Donald Trump's numbers have come down. So this is a pretty complicated situation. You are starting to see some folks like Governor Gavin Newsom stand up here, but I don't think there's an heir apparent, if that's what you're asking.
The reason why this is important is people are trying to get their hands around what fiscal policy will look like, especially as we head into what could potentially be some sort of recession that a lot of people are gaming out. We have certain fiscal plans certainly hanging out there. How much cohesion is there to get anything through if there isn't necessarily a frontrunner of the party, as evidenced by this poll?
Well, look, until we get further down the road, it's in Joe Biden's interest to make it clear that he could run, at least could run for a second term. If you have 2 years of lame duck coming, you're not going to get anything done here. So the president will keep his head down on this. The question that a lot of people have is what happens to Kamala Harris? When is the last time we saw a sitting vice president not be considered for the job at the end of this term? And we may start seeing more of her. We're starting to see her do more interviews, more media. I wonder if she becomes a more prominent and visible member of this administration post-midterms.
Joe Matthew, thank you, sir. Looking forward to the programme on Bloomberg Radio a little bit later. Sound on weekdays at 5 p.m. Eastern Time. Must listen a little bit later on some big issues. Big issue for us this morning. This cap at Heathrow is fascinating. So they've introduced a limit on daily passenger traffic to 100,000 through September 11th. Effectively, they're telling the airline to stop selling tickets this summer. Mohammed Al-Arian writing out on Twitter, and Lisa, we've picked up on this theme. He said, albeit an extreme case, this is a useful illustration of how persistent supply dislocations can lower demand, yet keep inflation high. That's what we talked about with Guy Johnson in London. You can limit capacity. What's going to happen to ticket prices elsewhere?
Exactly. People are going to want to travel. People still want to go on vacation. They still want to see family. They're going to look for a place where they can get that ticket. I mean, again, if you try to constrain supply, that's only going to lead prices to go higher, at least in the near term, before the trickle-out effects of the economic fall-through really take place. It really is a conundrum highlighting this pain point we could be heading into.
As Mohammed says, there's an extreme case. But how exceptional will it be, TK, through the rest of this summer, through the rest of this year? We're going to see other things like this.
We'll see other things. There's no question in my mind about it. It's going to be wildly uneven. And one thing I can say, John, is the polarity between what the United States is doing and other nations is really stark. The U.S. is distinctly different going into the third quarter.
Futures right now, negative 0.5% on the S&P. On the Nasdaq 100, we are lower by just 0.1%. Not as bad. Crude rolling over, down by 4.5%, 99.40 on WTI. From New York, this is Bloomberg. If you were looking for a bounce, it's not a great start to the week. Yesterday, not fantastic, very defensive. This morning, softer again. The S&P negative 0.5% on the Nasdaq 100, down about 0.1%. Muted price action on the Nasdaq, a gap lower on the S&P, and a little bit of a bounce off the lows in the last 20 minutes or so. The bond market picture reflected what you're seeing in the equity market story. 2s, 10s and 30s, yields come in lower, down by 7 basis points on a 10-year, down aggressively yesterday too, to 291.89, going into a CPI print tomorrow. And we hope again, I think, for the third straight month that we may have seen a mechanical peak in year-over-year inflation. 8.8% is the estimate so far in the Bloomberg survey, Tom.
The core matters
Core is expected to come in just a little bit.
Yeah.
But can you eat core, Tom?
No. And L-Arian had a great tweet out about that. No, I had a great tweet out. John, we got to state here on Global Wall Street that the currency market's not as upset as it was 2 hours ago.
Bit of a bounce off parity on euro dollar. I want to focus on commodities because there has been a breakdown this morning on Brent, on WTI. Brent down by 3 or 4 percentage points right now to 103. Just a little bit of a move off the lows in the last 20 minutes or so, along with equities. The move on copper, though, down by 2.3%. Goldman Sachs saying 6,700. That's a big revision lower on their price target into year-end for them, Tom. And they think that could come in the next couple of months. 74.17 right now on copper. Global growth concerns, Tom, at the epicenter of this market. Bramo said it earlier. Market's been betting against inflation, betting on slower growth.
John, we need to be flexible. That's all there is to it here. And for me, the Heathrow solution is you've got to be creative. I mean, if you're going to fly to Crete, you don't go through Heathrow anymore. You go Newark to Geneva, and then you go from Geneva into Heraklion Airport, which is not the main airport, but it's like good enough for Crete.
Are you Lisa's travel agent?
Yeah,
I'm just preparing her flights for...
Geneva, Switzerland looks
this
good.
Weekend. On a serious point, Tom, I really wonder what's going to happen with these airlines in Heathrow. If you've introduced a passenger cab, do they incentivize some people who got cheaper tickets to cancel? Do they have to move people around, cut their own flights to make sure that all the flights that are flown are full? It's going to be very interesting to see what they do in the coming weeks.
And then more importantly, American Airlines just out second quarter revenue up 12%. I mean, the fact is the seats are full and we're paying ginormous dollars. I mean, they're minting money.
I've got skin in the game. That's the reason I bring this up. If you'd like to take my August flight and incentivize me for cancelling that so you can sell it for more, I'm all ears. It's going to be interesting to see what they do. That's your cross-asset price action. Let's get to Bramo for some single names. Hey, Lisa.
Hey, this is the reason why I'm going to skip the flights to Crete and just simply drive up to Tupper Lake to do some portaging. Gap shares. I'm really focused on a bunch of different movers, including Gap, after they fired their chief executive officer, Sonia Singhal. She had come in 2020 to turn this company around. Gap shares down more than 50% year to date, and down almost 6% in pre-market trading. What will it take to turn around a company that has struggled both with concept and now in the face of a lack of consumer demand for basic goods simply because of the inflationary headwinds? Bed Bath & Beyond, another laggard in the retail space, shares down more than 60% year to date. Shares down about 0.2% in pre-market trading. But I point to Bed Bath & Beyond because they also saw an ouster of their CEO not so long ago. How much can a new person revive a retailer in such a different and difficult environment for them? And Amazon I'm pointing to because they have, of course, their Prime Day, which I'm only mentioning for you, Tom. Does anyone actually care about this stuff? I mean, is it just basically a marketing ploy?
I've never done it. I think it's
You've
just
never done Prime Day?
No,
Are you into Prime Day?
I think, Lisa, you're dead on. It's just a
sure.
ploy. What the bet here into earnings is what are they doing to right-size the cost that Bezos put on as he was going out the door? That's a 2-minute drill.
All right. Well, thank you. And I think that there are a lot of people who are probably participating in Prime Day. But it is.
I want 100 tablets, 100 tablets, dishwasher tablets. You know, usually they do you a nice offer.
Tablets? I thought you were talking about iPads so that you're buying 100
iPads.
iPads.
Money. Dishwasher tablets. I'm looking now to see what the sale is.
All right.
Thanks for reminding me.
Anytime. Put in your orders right now. I'm also looking at a number of potential winners, even amid this very difficult situation. I point to Pepsi in particular. They came out with guidance for the year ahead, upgrading for the second quarter in a row. Their expectations for profits up 0.8% in pre-market trading. Peloton up a whole 1% after saying that they were going to move their manufacturing of their bikes and other supplies to other partners and not make it in-house, an effort to really simplify. American Express, and John, this goes to a story that you've been talking about, down 2.5% after Morgan Stanley downgraded their expectations for the company. Why? Because of consumer spending and a pullback away from oil and gas. Exactly that Bank of America report you were talking about some of the card spending and what you're seeing in terms of the breakdown.
Yeah, a ton of price target cuts on some of the financials from Betsy Graysick this morning over at Morgan Stanley. Lisa, thank you.
I missed that. What'd Betsy do?
Cut price targets, Tom, and a ton of financials. Yeah. The banks ahead of earnings. Still priced in with her price targets at the moment. Some decent upside for some big names. Building on what Lisa said, though, on the consumer situation, the New York Fed put out their June consumer expectations survey. Short-term inflation expectations up. Medium long-term inflation expectations down, but here's the kicker. Home price expectations lower, spending expectations lower, credit access perceptions lower, household financial situation deteriorating. Just tick, tick, tick right across the board, Tom. Not what you want to hear.
Extraordinary to see. On the Amazon Prime Day, to close the loop, I'm looking at the Zonfaz solid bow ties.
So you are looking.
Self-tied for Tuxedo, down 27% on that as well. Kathy Jones with us, Chief Fixed Income Strategist at Charles Schwab. Is the great mystery here, Kathy, that we're going to want to be in fixed income with price up, yield lower?
Yeah, I think that the time to move into a little bit more duration has come, and we've been suggesting that for a little while now. You know, when you get 10-year yields above 3%, especially up in that 3.5% area at a time when the Fed is tightening and the economy, the global economy, is under a lot of stress. I think that safe haven move and that yield move is the way to go.
Kathy, Anna Hahn was on with a wonderful discussion of the tail risk out there off kurtosis. We rarely talk about tail risk in the bond market. I want to go there right now. How uncertain is the determination of what price will do in fixed income now? How malleable are the tail risks of the bond market?
Yeah, it's a great question, Tom. I think the question is, where in the bond market are we talking about? So we still see a lot of tail risk in credit, particularly lower quality credit, high yield, and even in the private debt markets, there's a building amount of stress there. So I think the tail risk there is pretty high. I think in treasuries, obviously there's some. I don't think it's immense anymore, simply because we've had such a massive upward parallel shift in the yield curve, and we've got the Fed tightening. That combination typically will, flatten the yield curve, invert the yield curve, and so that probably diminishes some of the tail risk at the long end.
Kathy, we were talking earlier about Marko Kolanovic being an uber bull and moving to being just a bull when it comes to risk assets. If you look at his note, it's actually really nuanced, and he has a pretty bold call on credit, saying that is not pricing in as much risk right now as stocks. Would you agree with that?
Well, I don't do stocks, so I can't compare the two, but I will say I think credit still has some a ways to go in terms of pricing in recessionary conditions or a further deterioration in credit quality and credit performance, both domestically and globally. So when we look at the high yield spread, it's moved up quite a bit, but we think it can move up another 150 basis points or so if we get into a pretty sharp downturn here, which it looks like that's where we're headed towards the second half of the year.
Which sounds like it could be controlled or it could be uncontrolled based on the pace of it. And I think about what Michael Shaul said yesterday on the show, where he was saying that we could start to see real market dysfunction that could actually get the Fed's attention. Do you see corporate credit as being vulnerable to that type of fissure that he's talking about?
I think the problem in corporate credit is the liquidity issue. So yes, at the very low credit quality, we could run into some problems there, and I think access to the market would be really difficult, and probably is getting more difficult for, say, CCC rated, low rated corporate issuers. But I think in the investment grade space, what we worry about is just liquidity, because the dealers are not holding as much. The banks, the dealers are not holding as much. A lot of it has moved into the private market. If there is a dislocation, it's simply the inability for the market to get the liquidity it needs to get the price and yield right. So we could see some problems there. We're not anticipating it, but it certainly could happen if things deteriorate quickly.
Kathy, thank you. Always wonderful to catch up with you. One of our favourites, Kathy Jones there of Charles Schwab. The tone of this equity market improves a bit. We're down 0.4 on the S&P with positive 0.1% now on the Nasdaq, but capturing some of the tension in the bond market. The distance between a 2-year yield and a 10-year yield, Tom, is negative 10 basis points this morning.
Yeah, it's real simple. It is back to the great financial crisis. And I'm not comparing the two, John. I think the situation right now is radically different, particularly given leverage. But the fact of the matter is this bears watching. Let's walk through it, John. The 10-year yield as compared to the 2-year yield is the vanilla spread. There's 47 other spreads out there. Lisa's got them all memorized. I don't. And the answer is the 2-year yield is higher than the 10-year yield. So you go through zero and down you go. And the amountedness of it is a huge deal. 10 basis points of inversion is a different story than 3 basis points of inversion.
When you are willing to accept a lower yield on a longer dated maturity than a short-term maturity, Lisa, typically that signals some kind of problem.
And as you cited earlier, it just really is a question of how we get there. Is the path going to be gradual? Is it going to be controlled? Or is it going to be violent? Is it going to be something that's much more significant when it comes to both the market and economic disruption? And that, as you said earlier, and as Tom has been talking about, is what the market is trying to figure out right now.
That's the bond market. We need to talk about the foreign exchange market. Jordan Rochester of Nomura was looking for that move to parity. We're basically there. He is factoring in some dollar strength and maybe some more. We'll catch up with him next on this program. From New York with Tom Keene, with Lisa Abramowicz, I'm Jonathan Ferro. Futures negative 1/3%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. OPEC's first oil market outlook for 2023 has been released, and it suggests no relief for squeezed consumers. The cartel expects global oil demand growth to exceed the increase in supplies by 1 million barrels a day next year, but members already are falling far behind the volumes needed right now. In the UK, retailers reported another drop in sales. Record high inflation is keeping consumers from spending on discretionary products and services. The British Retail Consortium measure of sales fell by 1.3% last month from a year ago. In Shanghai, there are fears the city is heading back into lockdown a little more than 5 weeks after exiting a 2-month ordeal. The city reported 59 new coronavirus cases on Monday. That's the 4th day in a row that case numbers have been above 50. The detection of a new substrain of the Omicron variant triggered 2 more rounds of mass testing in Shanghai. And Croatia will become the 20th country to adopt the euro. The EU gave its final approval today, recommending that the Adriatic nation of 3.9 million people be allowed to begin using the common currency. Croatia is the first euro newcomer since Lithuania back in 2015. And PepsiCo's raised its outlook for the 2nd quarter in a row. The maker of Mountain Dew, Fritos and Quaker Oats expects revenue to grow 10% this year as consumer demand remains resilient. PepsiCo's North American food and beverage business remained strong during the quarter. Meanwhile, demand for convenient foods helped international markets continue to perform. And it is the first time human beings have seen a distant galaxy cluster as it appeared more than 4 billion years ago in such vivid detail. President Biden unveiled one of the first full-color images from the James Webb Space Telescope. The telescope was sent into orbit roughly 1 million miles from Earth late last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you look at how much the euro has overshot in the past, we've come up with a range of anywhere between 95 and parity. And I think in the current environment, that sort of range is not really unreasonable.
George Saravelos, the global head of FX research at Deutsche Bank, seemingly everyone on board with this story now, looking for a weaker euro. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro looking at futures with a bit of a bounce. We're negative 0.5% on the S&P. Yields lower by 7 basis points on the day on a 10-year. Crude at 99, down by 4.75%. And euro dollar, let's just call it parity. Jordan Rochester of Nomura, Tom, looking for 95 by the end of August. More pain to come for that currency pair.
When we invented Bloomberg Surveillance, folks, it's about bringing in the experts, John. And what I think we can say, John, is Jordan Rochester at Nomura is nuanced and different than George Saravelos at Deutsche Bank, is nuanced and different than the giant Stephen Englander over at Standard Chartered. And to talk to all those people, to read their research, helps us collate around this shock that we have.
Should we bring in Jordan Rochester right now?
You bring him in right now. You bring him in right
Jordan,
now.
where'd you get the extra downside from on euro dollar from where we are down to, say, 95 in August?
Morning, everyone. Afternoon, everyone. Well, in terms of why we think euro carries on, the risk is, of course, these gas flows, but there's also a global recession story building up. So I think most analysts have now only just realized euro can keep heading lower. There was actually quite a bit of a fight in the sort of sell side community around the 106 level when the ECB turned hawkish. Well, now it's quite clear the gas flows are dominating. And the reason it goes to 95 is probably three reasons. The first one is the gas flows. We think that there's a high chance that Nord Stream doesn't resume its operations. And what we're seeing is a fundamental macro story. Euro-dollar is heading lower because European importers of gas are buying whatever they can buy from the US, from Qatar, from Azerbaijan. They're just throwing money at the wall to make sure the EU achieves their 80% gas storage aims. They're roughly around 62 or 66% full, so they've got a lot more to do, and that's forced euro selling all the way until that target is reached.
Jordan,
the second reason is China.
Okay, continue. Sorry, continue.
The second reason is China. China's COVID business cycle. Before the break, we had a little first word there telling us that Shanghai might be going into lockdowns again. That's the biggest trading partner for the euro area. So demand has just come out of the curve for European exports. And the third one is recession risks. The US raising rates the way they have, the way the world has moved with the supply chain and inflation. The ECB is going to raise rates in July, September, October, and so on. But we're talking about rate cuts here at Nomura next year. I think that's the next trade. And I find it really interesting how there's so much Fed cuts priced for next year. The curve's inverted. But that hasn't happened in euro yet. So that's the next story. And that's going to weigh on euro as well. So it's not just all about gas flows. It's a bigger story. 2-10
spread moving from -10 to a -11 basis points. Get your attention. Jordan, you and I were weaned on reading Dooley, Folkerts, Landau, Garber. David Folkerts Landau over at the big German bank makes real clear at some point we have to step in. Using euro as a proxy, are we anywhere near on a Jordan Rochester 0.95 where institutions will step in to staunch the dollar strength?
It's definitely possible, but I think it's unlikely. It's definitely not my base case, I can say that. So when the euro was invented, there was FX intervention. That was the authorities around the world stepped in, the Federal Reserve, the Bank of England, and so on, to help support the currency so that it didn't spur a Eurozone crisis in its early infancy. So there was a joint effort there. And at the same time, inflation was not as much of a problem as it is today. Right now, every central bank around the world pretty much wants a stronger currency. It helps tame inflation from import costs. So that's why we're seeing even the likes of the S&B, who have for years fought the curve and tried to not have a stronger currency. They're pretty much asking for one. Well, the Eurozone, they can do that via rate hikes. And I think that's the main way they're going to possibly do that. But as I said earlier, the growth story is much bigger than just the rate hikes. There's what's going on with gas in China. But FX intervention is being talked about in Japan as well. Another great example. The authorities there say the move is detached from fundamentals, where most of the charts we look at say actually the move is quite in line with fundamentals. That's the same with the euro. We've had a huge terms of trade shock, Tom, and German exports have now become very uncompetitive. The cost of electricity and energy in Europe is roughly around 6 times higher than America. So to make a piece of manufactured equipment, you're paying 6 times more in electricity costs. You're uncompetitive versus an American firm. You need a weaker currency to help you out.
Jordan, I want to tease out the potential cases that you lay out in your most recent note. 95 is the most likely that you see by mid-August, or the end of August, I should say. That's according to your latest note. But you said that a 90 print could actually be reasonable to look for over the winter if we do get a Nord Stream 1 cut off, if Russia does not restore the gas supplies. At what point does something break? At what point is there a level at which you start to see a contagion that perhaps is not linear?
Well, I think 95 to 90 is non-linear. What breaks? Well, I think credit channels will be much more the area where things break. So the rise in interest rates we've seen, the drying up of consumer demand, we're going to see a lot of business models really challenged, and that's where you'll have something breaks. The irony of that is, if you have credit spreads widen, that leads to a dovish central bank typically, and that would mean a lower euro. So I still think the exchange rate is the release valve, and I don't think the exchange rate is what's going to cause that stress. It's coming from the supply and the demand side of the equation when it comes to those risks. But look, when we get to 95, we're kind of basing that on the Nord Stream 1 flows maybe coming back to 40% of their capacity. What 90 cents is, that's the scenario where Nord Stream 1 does not come back on and the euro area does not get enough gas storage and the German manufacturers get their gas rationed. The Bundesbank in Germany have already done the analysis. They expect that's a 5% hit to German GDP if we have gas rationing. Outside of COVID, That's one of the biggest economic shocks we've ever seen. So that's a crisis. You need a weaker currency to help you out.
Jordan, just quickly, we've got to squeeze this in. We're rationing flights at Heathrow. Heathrow out this morning, basically putting a passenger limit on airlines through September 11th. What did you make of that? How important is that story for you?
It's the summer of discontent. For a lot of people, this is a personal story for their own lives. I'm flying next week. I'm flying with British Airways. So maybe this will disrupt my flights. But on a macro scale for the UK, it's going to lead to a summer of discontent. It could lead to higher wages, more broadly speaking, and that makes life trickier for the central banks. They're looking at high inflation, looking at rising wages. They should be raising rates in that scenario. But they're also seeing economic crisis building up in the future, in their pipeline, especially if the gas situation gets worse. So the central bank's in a really weird place. They need to raise rates to tame inflation, but they'll be looking at negative growth. So that summer of discontent just keeps central bank in that weird place.
What a tough spot. Jordan, thank you. Jordan Rochester there of Nomura. TK, the UK, Europe, things getting harder and harder, seemingly every morning at the moment.
Yeah, there's, in Europe, that's there, and there's all these micro stories. I like what El Arian said about little fires this morning.
You
John,
said that a few times, yeah.
To go to the other side of the world, Rebecca Chun-Wilkins out on Twitter for Bloomberg writing on property bonds. I don't know anything about this in China, but we're underplaying the stresses in China, as Mr. Rochester just talked about.
Couldn't agree more, Tom. We talked about that a few times this morning. The prospect of more COVID restrictions dragging down commodities too. Yeah. WTI 99.34. We're down by 4.6%. Coming up shortly, Jim Paulson of Leuthold Whedon Capital Management. Looking forward to that. Futures negative 0.5% from New York. This is Bloomberg.
The sort of underlying economy, the labour market, obviously can withstand a fair amount more tightening, but financial markets here are wobbling.
I'm shocked that interest rates are as low as they are.
The action is in the currency market right now.
What we're seeing globally is essentially a huge hoarding of dollars from investors.
The big market call is much more volatility coming forward.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on Global Slowdown on radio, on television. Thank you for joining Global Wall Street and all of you concerned about this international slowdown. John, everywhere I look, that is a signal.
Yeah, and you see it in the FX market loud and clear over the last few weeks. Euro dollar moves we haven't seen since 2002, the worst year since 2001. And underpinning behind that move, Tom, as we know, is an energy issue, perhaps an energy crisis in Europe's future. Perhaps that's already here.
We see it with the death of ESG, coal moving out, Newcastle coal. We see it in Rotterdam coal as well. But, John, what I want to focus on in the last hour, we have curve inversion, the vanilla curve, 210s spread. For those of you keeping score at home, back to 2007.
It's been developing over the last few weeks, Tom. Negative 10 basis points. Your 10-year right now, 292, down 6 or 7 basis points. Yeah. We've had 2 big days for treasuries, Tom, going into CPI tomorrow. And some people think we could get very, very close to a 9 handle on headline CPI.
That's headline CPI, and then there's core CPI. Lisa, how do you focus on the inflation data tomorrow into what will occur in fixed income?
It doesn't seem like nuance is necessarily going to rule the day when you take a look at a headline number that could come in with a 9 handle at 9% year over year at some of the most extreme cases and predictions. If that's the case, you can expect people to start to price in 275 basis point rate hikes this month and then in September. When you talk about the core, maybe on the margins that could be used as an excuse. But the Fed chair himself has come out and said this is not a time for nuance when you have inflation at the hottest pace going back to 1981.
Yeah. John, Jordan Rochester tiptoed around it. I believe Steve Englander is scheduled to be with us as well. We're trying to bring you the best on Wall Street, folks. Jim Paulson to join on Equity Spirit here in a moment. But, John, do we have any idea of dollar strength and everyone else erosion when Lagarde and other institutions will step in? I don't have a handle on that.
Well, you tell me. Is a central bank rate hike from President Lagarde bullish or bearish for this currency, Tom? Can you answer that question? I can't answer that question.
I don't know. As I mentioned, it's Jump Condition Tuesday. And, John, you bring over to EM. Everyone's telling us EM doesn't matter. I don't buy it.
EM matters, Tom. China matters more. For this global economy, China matters more to this commodity market too. We said it through this morning. We've underplayed that story. Many people have over the last few weeks. You can't make a call on this commodity market without a deep understanding, a better understanding of where the Chinese economy is going year end and whether President Xi moves out from this lockdown on, lockdown off story of the last 2 years.
Dollar renminbi to start the data check down, weaker jump condition out 2 standard deviations in a narrow range, 6.72 yuan per dollar. And that shows not so much currency as a mechanism for China, John, but that there's an immediacy to their actions to stabilize their economy.
And let's whip through this price action. Crude lower off the back of some of this. Commodities softer. Copper heading south. Yields coming in 7 basis points. Tom talking about the difference between 2s and 10s, the distance between the two, negative 10 or 11 basis points. In the FX market, euro dollar 10038, and moments ago on this program, Jordan Rochester of Nomura talking up the prospect of hitting 95, Tom, and maybe going below that level, but acknowledging that any call on going south of 95 ultimately is a call on what happens with gas supply later this year.
It is, and the gas supply is a calendar item. John, how do you focus in the record heat that we're seeing now across continental Europe?
Brutal, Tom, brutal. And it's going to get harder and harder later this year. I think the more important factor right now for Europe is what happens with Nord Stream 1 when it comes back online, how much gas supply we get through that, Tom, and how much gas supply we get later this year. For the ECB, I keep going back to this, Tom. What's the optimal policy for the ECB? Is there one?
I don't know. I don't think they're making it up as they go.
Is there one? They meet next week. They meet next week. This is their world right now.
Yeah.
It's brutal, Tom.
I think it's brutal, and to John's point, folks, I would suggest so much of our economic theory in action now is being made up as we go. James Paulson joins us now, Chief Investment Officer, Luthold Whedon. He knows that Minnesota is not in drought, but off to the southwest, there is serious drought issues across farmland of America. Jim, let's start there. What is a symbol of what commodities are doing with the latest corn surge? How do you fold the Midwest commodity surge into the mix of investment dynamics?
Well, I think that I've always said, I grew up in Iowa, Tom, and I always said that Iowans are related to Texans in a country that likes disinflation. And actually, inflation, it always did good for the Iowa economy, and it always has done good for the rural Minnesota economy, and as well as like Texas, but much of the rest of the country does better without it. And there's a lot of rural America that's benefited greatly from the rise in commodity prices in general, and they'll start to feel the pinch, again if it comes off. Which I think it is. I think it's already starting to go that way. But it's always kind of been a situation where you're an inflation business in a disinflationary country. You always feel a little bit foreign, if you will, overall.
Jim, we've all been told once or twice over the years that you should seek discomfort in markets. That's where the big returns are. Are you ready to get uncomfortable or comfortable where the discomfort is right now?
I've been uncomfortable for a while already, Jonathan. This is the bear market that won't end. So I don't have to get uncomfortable. I've been there already. It just seems clear to me that if you look at the stock market, it's going to need to some inkling that the tightening monetary and fiscal tightening packages deployed across the world, particularly the United States, has got to come to an end, and to see some end in that. And I think we're getting closer than we think. I really do. I look at the Fed, and I think it takes its direction from its boss, just like you and me do. And its boss is the economy and the bond market, in my view. And right now, I think there's a pretty consistent message coming from the Fed's bosses that they need to think about wrapping this tightening cycle up. If you look at real growth, you're just talking about global growth really slowing. It certainly has here in the United States. The economic surprise index is the lowest it's been in this recovery. The GDP now number looks like another negative print for the second quarter. Real growth has certainly slowed dramatically. That's saying that that economic growth boss is telling the Fed it better wrap this up. I think on the inflation front, I think we're winning the war. I know we're going to get a hot print tomorrow due to energy, but we also know that the next couple months after that, we're going to get negative reads from energy, big time, headline declines. Commodity prices have been a constant upward thrust on inflation, they're now going to become a deflationary thrust on inflation. And core CPI, PPI, PCE have all been decelerating in the last couple of months. Wage inflation year to date is up only 4.5%, a clear deceleration. You know, I think there's a lot of evidence inflation's rolling over.
As you talk, I think to myself, and I'm extrapolating out, so correct me if I'm wrong, does this mean that you're going long tech because you see the belief that perhaps the Fed will back off, and you're actually paring back on the commodity space if you're seeing a peak inflation type of environment?
Yes, I would, Lisa. That's kind of where I'm at. I think that then you look at the bond market, it's giving everyone a 50 basis point rate cut from 2 years to 30 years. The break-even rates have collapsed. The one-year break-even rates fallen to 3.75% this morning, down from 6.5% just 3 months ago. It could be back to the 2% handle target of the Fed by the end of summer. So I think we get a rate pause, not a rate cut, but a rate pause by the Fed, maybe by the fall time. And if the market starts to pick that up, they're going to move away from commodity cyclicals. They're going to move away from defensive stocks. And I think they're going to move more towards early cycle stocks, maybe consumer discretionary. And also, to your point, Lisa, I think technology and growth gets a leadership run again.
Hey, Jim, awesome to get your views, as always.
Done.
Jim Paulson of Luthold Whedon, uncomfortable, seeking discomfort through most of this year, Tom.
Folks, that was such an important interview to go to Jim Paulson out in the Midwest. And, John, this is the divide. And to use the zip codes of Minneapolis, the 55402 versus the 10022 Wall Street financial divide, it's stunning right now. I mean, Jim just flat out says there, enough, slow down.
Providing any kind of outlook right now is tremendously difficult, but I'll allow Nomura to provide you with one. Here it is. Expect a recession to begin in Q4 22 with a risk of an earlier start. They expect an additional 75 basis point hike in July, 50 in September, 25 in November and December, and February 23. Then the cuts arrive. It's the rate cut call, Tom. 25 basis point cuts per meeting are likely starting September 23 to 0.875% by the end of 24. That is like way off.
John,
I've
never witnessed this. I don't understand the guesstimates of getting the incense bottle out and rubbing the sides, trying to figure out 2 cycles out.
I'm with you, Tom, but isn't that what the clients are asking right now? When do the cuts start?
Yeah, okay, that's what the clients...
When do the cuts start?
The answer is we don't know. The answer is maybe we don't know. John, I'm looking at log sterling here. What is the ramifications of a 117-pound sterling? It is an elegant chart, wicked south.
I can tell you it's driving Bramo nuts.
Well, I just think that there is a bigger point here, regardless of the parlor game of when the rate cuts begin, that people have been so conditioned that that's what will happen. They have not been conditioned by inflation that's going to become entrenched, and they don't buy that story. And that, to me, is the big takeaway from the idea of a rate cut call.
It was my number one takeaway from my interview with Mohammed on Friday. Mohammed Al-Arian turned around and said, how sticky will it be? That's the number one question you need to be asking guests. How sticky will inflation be? Beyond these prints of close to 9%, we've got to live with 4 or 5, and for how long 4? Futures down 0.5%. Steve Englander of Standard Chartered, the brilliant Steve Englander on this FX market, coming up shortly. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. OPEC's first oil market outlook for 2023 has been released, and it suggests no relief for squeezed consumers. The cartel expects global oil demand growth to exceed the increase in supplies by 1 million barrels a day next year, but members already are falling far behind the volumes needed right now. The Conservative Party wants to narrow a wide field of contenders to be Britain's next Prime Minister. It will require candidates to have the initial support of 20 Tory members of Parliament. Nominations will open and close today, with the first ballot to be held on Wednesday. The party's new leader, and therefore the UK's next Prime Minister, will be announced September the 5th. London's Heathrow Airport is moving to limit the recent travel chaos. It's asking airlines to stop selling tickets for summer travel. The biggest airport in the UK will limit daily passenger traffic to 100,000 people through September the 11th. Heathrow is scrambling to hire more staff and says new recruits aren't up to speed yet. And American Airlines is sticking with its expectations for a jump in second quarter sales despite rising costs. In a filing, American said total revenue is expected to be up 12% in the period compared with the same quarter back in 2019. Meanwhile, costs for each seat flown a mile will also rise about 12%. And Peloton is taking one of the most dramatic steps yet to simplify operations and reduce costs. The company will quit building exercise bikes and treadmills at its own factories. Partners will now handle the manufacturing. Peloton is making the change after several months of turmoil. The company cut nearly 3,000 employees earlier this year and shares are down some 75% in 2022. Global news 24 hours a day on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We've taken commodities down sharply. We've taken oil down 25 or 30 bucks, and discretionary has given us nothing, right? So this idea that some pause in crude or some weakness in crude would suddenly recatalyze the consumer, I think the market is suggestive of that not being the case here yet.
Chris Verone there of Strategas, a bad company. Futures down 0.5% on the S&P. And to Chris's point, here's crude. Lower again by 4.6%. We are down to 99.23 on WTI. Yields lower by 7 basis points. 292.25 on a 10-year. And euro dollar positive just about by 0.1%. Euro dollar 10046 after basically hitting parity a little bit earlier this morning, Tom.
Doing what we're doing, which is to get the best voices we can on this time of shock on the data screen and maybe some potential crisis as well. He is absolutely definitive at what are called cross rates, which are the nuances away from euro dollar, dollar yen, dollar dynamics, the study of all the major currencies. Stephen Englander, iconic at Citigroup and now head of all of FX research for the important Standard Chartered Bank of the Pacific Rim. Which is the cross rate, Steve Englander, right now that gives you the most information?
Well, I think it's the, looking at the euro. I mean, it's just that it's so pivotal for everything and the market is so short. The other crosses I'm looking at, you look at what Asia is doing, particularly EM Asia. It's through this episode of dollar strength. It's really outperformed. And were it not for yen weakness, which is a story on its own, I think that EM Asia would be viewed as actually outperforming very well in this world. Doesn't mean that it's a buy right now because it's risk off and we're moving into recession, but it does mean that, on a relative basis, it's been far more stable than G10.
Do you assume that yen catches up with euro weakness, that we see yen go 136.78, dare I say a 140?
I think Japan's policy stance is puzzling. The BOJ Governor Kuroda said that they, discussed the need for more ease, which I think was a tough one to figure out. I think the ECB's silence on the euro in terms of its weakness, I don't think a weak euro is doing them any good right now. So, I think that the Asian currency managers are more prudent in the way they manage their currencies and are not particularly looking for excess weakness right now.
Stephen, given all of that, you have a pretty bold call where you basically think that it's getting harder and harder to get the dollar stronger from here. And that what we've seen from the reaction on Friday, and John was talking about this yesterday, of actually dollar weakness on the heels of a stronger than expected non-farm payrolls report, highlights that people are overly long dollars. And that really sets a bar that is very high. So what does that mean in terms of how significant this could unwind, or whether people are really misreading the market right now?
Well, I think the key thing right now is whether gas supplies are restored in 10 days or so by Russia. If they are, I think euro shorts are in a bad position because a lot of this week's euro selling is on the back of concerns that literally the lamps are going to go out in Europe. If it turns, at this point, their gas kind of inventory seem to be normal. The question is, can they continue to accumulate? And that would sort of lead, actually dissipate some of the pessimism, I think. So it's a very important, it's one of the key things for the euro right now.
So do you foresee the idea of breaking below 95, the way that Jordan Rochester was saying, that we could see the euro go materially lower? Do you think that people are underestimating how much people are already positioned for that weakness at this point?
Oh, yeah. I mean, this is very different than, say, 2002 when the euro went below parity, when everybody had started off optimistic and long euros. And this was a real disappointment to the market. I mean, the market has been preparing for this for a couple of months. And I don't think the significance of parity is anywhere close to where it used to be.
Steve, I looked at log trade-weighted dollar, and the steepness up to Plaza Accord was stunning compared to, yes, a more persistent strong dollar now, but nowhere near the movement that we saw in the early 1980s. Are we anywhere near where institutions come in to staunch the dollar?
I think we need some good news. I mean, you look at the news flow, China COVID issues, the Russian gas, ECB kind of ambiguous on what they're going to be doing. All of this is kind of risk off. So I think the dollar is supportive as long as that's the news flow. But I think if there's any, any signal that, there's some merit to optimism, I think we will see the dollar come off. I think the market is very long dollars right now.
Steve Englander of Stand Chart, great to catch up, taking things back 20 years to the early 2000s. Tom, early 2000s, do you remember that lineup at Citi in the early 2000s? Steve Englander, Bob Singe, Steve Saywell. What a lineup of foreign exchange that was 20 years ago.
Let's stop here, folks. And this is really important, and that John and I really, really look at the pedigree of the different shops. And people bounce around and move around as well. But they each have a certain character. Each one of these firms is different. We're trying each day to give you a cross-section around them. John, I would look at Folkers Landau and Deutsche Bank now as absolutely fascinating, the contributions they've made recently.
I go back to that team 20 years ago at Citi, Tom, because I think it produced about 5 heads of foreign exchange on Wall Street. 20 years later, over the next 10, 15 years.
Yeah, you follow the pedigrees. I think Bob Sinch is running a hockey camp now. I'm not sure of that, but it's north of Old Forge. Maybe Lisa can see her when she portages.
When Bramo flies off this weekend.
Yeah.
I'm not flying. I'm driving. Yeah. I'm worried about getting canceled.
On the break,
these
folks,
airlines. I mean, seriously.
People on the break here, they're like, what do they do on the break? Well, yeah, I mix some more Tang. That's true. Lisa's completely focused on deer fly repellent. The 3M Ultrathon insect repellent looks to be the one, Lisa.
Is that serious stuff, Tom?
Yeah, it is. It's got like 47 chemicals
prepared.
in it.
If you're just tuning in, believe it or not, stuff's happening.
I was about to say, I'm watching the yield curve.
0.5% on the S&P, and some interesting stuff in the bond market too. 2s10s inverted. Where are we now, Lisa? 10, 11 basis points
it
negative?
Hit 11, it hit and it's the most going back to 2007, which I think is notable. We crossed the 11 basis points. We are now firmly through that. Negative 11 basis points.
Round it up, negative 12.
Yeah, looking at 12.
Round it up.
Stunning.
Round it down into CPI tomorrow, where we look for something close to 9%. Interest in the direction of travel here, Lisa, going into that CPI print tomorrow. Retail sales later this week too. You, Mitch, I mean, I never thought we'd sit here and be talking about consumer inflation expectations of the University of Michigan Consumer Sentiment Report, but here we are because of Chairman Powell, I guess.
There is a consensus right now that is building that longer term we will revert back to a normal. The issue is how we get there. And now that seems to be the question that people are parsing through. But the consensus, at least for the moment, is for that longer duration bid.
Futures down 0.5% on the S&P from New York City this morning with Tom Keene and Lisa Abramowicz and Jonathan Ferro for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg Surveillance. The week really getting started, and on the data front, it doesn't really start until tomorrow when we get CPI in the United States of America. Right now for markets, we are all go lower on the S&P 500. Futures down by 0.4%, breathing a little bit of life into the NASDAQ over the last hour or so, positive by 0.06%. Into the FX market, euro-dollar unchanged, basically hitting parity earlier this morning, 100.39 on euro-dollar. We spoke to Jordan Rochester of Nomura, who's looking at 97, maybe down to 95 on euro dollar through the summer off the back of what may or may not happen with gas prices. And that's the problem, Tom. You've got to have a forecast on what happens with gas prices to have a forecast on what happens with Europe and ultimately with the currency.
I think the linkages are there. We had a pause here in the last 2 hours, John, but can you imagine, John, if we roll over and retest where we were at 5 a.m., 6 a.m. this morning?
On the euro, Tom.
On euro, on sterling. The sterling chart is shockingly elegant, John, as it goes away. I mean, John, are you a prime minister candidate?
I'm not, Tom. Would you like me to throw my hat into the
ring?
No,
everybody else has.
I'm not a member of the Conservative Party.
I get baffled.
If I was an MP of the Conservative Party, Tom, and I'm not sure many people would like that to happen, then sure, you and I could make a run for it. You'd be my chief advisor. Let us pause, get Larry the cat. Let us pause here right now, folks, with an annual visit that we do with Anat Ambadi. She is at Stanford University with classrooms that are packed, railing about capitalism in a constructive way. It is her goal not to tear down our banks or our financial system. It is a goal to inform on their size. She's economics and finance professor at Stanford University and looks at this through an operations research perspective. It has been far too long. Wonderful to have you back. Thank you for joining. I want to go to what I think is unspoken, which is using JP Morgan as a proxy. Pre-pandemic, they had operating income of $45 billion, and after the struggles of the pandemic, they have operating income last 12 months of $53 billion. They're up 15% or whatever. They have sales per employee to die for, which is $460,000. Why are these banks that you often criticize constructively, why are they such profit-making juggernauts?
It's wonderful to be a big bank like JP Morgan Chase. It's a good life. It's a wonderful life. The pandemic worked fine for them. I talk to people in the sector. I look at how they did through and why, and you can see whatever you do for the economy, they end up benefiting too.
How do they attach themselves to the rest of America? James Dimon, Brian Moynihan, all the others will trot out all sorts of social programs, diversity programs, and the rest. If we have such success, if we have American banking being so profound, how do they extend that out to the rest of the country?
Well, I mean, they're just very privileged. I mean, if you say, how do they attach themselves? I mean, you know, we wanted to give PPP loans to small businesses. Well, the bank stood in the middle of that, got a little spread at no risk and fees, and it was a great windfall for them. Then the Fed bought corporate bonds and enabled a lot of issuance of bonds, and that was great profit for investment banks. So once again, you know, it worked out for them. You know, whatever bailout or support comes to anybody, they get a piece of it.
The arch question here, it came up the other day. Paul Krugman, I know, is led on this as well. I'm very, very big on this. Not monopoly, folks, but monopsony, which is a very different thing. You are one of the world leaders on this. It's like a rubber plantation in Singapore where the only place you have to sell your rubber is to one party. How monopsonistic is America now, and is that our capitalistic angst?
Very much so, and it's just a matter of power, of bargaining power, of power in the law. I mean, if you look at the way we now allow, you know, mandatory arbitration to be enforceable for consumers, for employees, you know, non-compete agreement, et cetera, there are all these subtle ways in which you know, corporations have power over people who work for them, whether they're defined as employee or gig worker, contract worker, or whatever. So it ends up that this power gets wielded.
Anat, you talked about the banks and how they always come out ahead. And we're talking at this moment, going from the macro to this micro moment, where people are talking about some possible disruption in markets that's significant given the tightening from the Fed, as well as some of the concerns about longer-term growth. Isn't it, frankly, a support for markets and a testament to their strength that we haven't seen some sort of mass disruption akin to what we saw in 2008, given how quickly things are moving?
I'm not sure that we will see disruption from this slowdown in the economy. You know, ahead of all interest rate increases, there are ways the banks can increase mortgage rates, other lending rates that are sort of pegged, and so it's not clear that it's strong just because it doesn't implode in a given moment, because the system only starts really cracking seriously if there's a massive, fear or run or somebody fails and all the dominoes start. Right now, we're seeing crypto action, which bears similarities to some of the issues we saw in banking, excessive borrowing, all kinds of defaults and chains of defaults, collaterals, etc.
But that's exactly the point, and I want to let you continue with that idea, but we always never expect the stress where it comes, right? It's never going to come in the same place. Where are you seeing the nodes of potential contagion, the nodes of stress that might not be in the traditional forms of finance that we saw in the past?
So my big fear that I've developed as I started thinking, Jamie Dimon likes to say, or says that he told his daughter that a crisis is just something that happens, a financial crisis, every 3, 5, 7 years. So by then, we're really due for one, according to him. And my fear is cybersecurity. That is really what I think. If you read Nicole Perlroth, this is how they tell me the world ends, or even fictional things like, 2034, you kind of know that there are things lurking potentially. And they hacked the New York Fed. They're hacking, and they're lurking. And then all of a sudden, I don't know, should I print out my banking statement? Like, who can take over? Now, I think banks might be more prepared than other industries. But if you look at the Colonial Pipeline and some of these disruptions of infrastructure, we can have a lot of contagion if it starts being, they hack hospitals, they hack municipalities. So if it's warfare, from the digital dimensions, who knows?
And now we got to get back to the markets here with the way they're moving today. Right now, folks, a little green on the screen with NASDAQ, actually, at green. Have you ever been to the Hoover Institution? Did they let you in the door there? Have you ever darkened the door of the Hoover Institution?
Yeah, I talk to people, so I have great friends there.
Okay.
Yeah, I have great friends
I want to
there.
talk right now about the minority in this world, which is progressive economics, liberal economics, in a conservative America. What is the single legislative linkage progressive and liberal economics can have with a broader conservative America?
My big battle that you've been familiar with, which I just sort of gave up because I got a little bit tired of spending all my time on it, is very bipartisan. The idea that you'd be on your own able to absorb losses. That's bipartisan. Senator Sherrod Brown.
If the banks take a loss and clear the
Well,
markets.
more equity funding. I mean, there was a proposal by David Vitter when he was there in the Senate with Sherrod Brown, and they had Senate, can you believe it, back in 2015, vote unanimously that they don't like too big to fail subsidies, except when it came time to discussing how to deal with too big to fail banks. They wouldn't vote for 15% equity, which is just for the top 6 banks, which is so radical. But no other company ever has less than that.
We've got to leave it there where the market's moving. Professor Admati, thank you so much for joining us with Stanford today. Too long a visit here. And John, it really harkens back to too big to fail. And some of these market indicators harken back to where we were 07, 08.
If we're thinking about crisis, what did Michael Schall of Market Field say yesterday? Lisa, don't look to where you typically look for a global FX crisis, maybe in emerging markets. What did he say? He said, look to Europe.
Yeah.
We're looking to Europe in a bigger way.
That could potentially drag things down, which really raises a question, at what point do things break? And Jordan Rochester was saying, we're getting there to that nonlinear place. Now, what is the trickle effect? And is it just basically the representation of the stress being diverted into FX that otherwise would be felt in spreads?
ING was talking to the team earlier this morning, and he basically just turned around, an economist at ING, a rate strategist, I believe. It's not about if or when there'll be a recession. It's about how deep it will be in Europe. That's what we're all trying to figure out, how deep it will be. And with that in mind, this has really crept up on us. Next week is the ECB meeting. It's next Thursday. We're going to see something from this ECB that we haven't seen in 10 years, which is a rate hike, Tom. A rate hike, and then what? Another one? And
And John, I'm sorry, the importance of it is tangible, where, you and I should get on the Gulf Stream and get over to Frankfurt and cover this properly.
Are we going to fly through
have
Heathrow, Tom?
Landau out. No, we're not going through
Getting
Heathrow.
there might be difficult at the moment.
But, have Folkers Landau on and others to talk about this historic moment for Christine Lagarde.
We've talked a lot about the invasion of Ukraine over the last 6 months, and the next stage, at least of our coverage, and of course we'll cover that invasion of Ukraine and the war as it's ongoing, is the economic fallout. And that's just starting to come to the surface, Lisa, in a much more pronounced way.
And what is that economic fallout? I'm still sitting here trying to think about what the ramifications are for artificially curtailing the supply because of a lack of workers. Doesn't that lead to higher prices? Doesn't that lead to higher wages, at least in the short term?
At least to devaluation and higher prices. That's precisely
so then
correct.
How much does that trickle out into an economic proposition that is potentially problematic? And what do central banks do with that?
John, it's John Taylor 101, even in Adamati. It's the only thing she agrees with John Taylor on. As you know, it's simple. Depreciation, price up.
I can tell you she's smiling at the corner of my eye. Erin Brown of PIMCO
just busted her chops.
Is going to be joining us in the next hour on Bloomberg TV, alongside Sarah Malika-Nuveen, the CIO, and Jean Bavin of BlackRock around the opening bout on why they're becoming less constructive on equities over at BlackRock. Futures are down by 1/3 from New York City. Good morning to you. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Rita Gupta. President Biden and Mexico's President Andrés Manuel López Obrador will discuss ways to expand legal migration and improve security when they meet today at the White House. They'll announce joint actions to improve infrastructure and cooperation along the almost 2,000-mile border. López Obrador says increasing immigration would strengthen the U.S. labor force and help curb inflation. Billionaire real estate titan Sam Zell is urging the Federal Reserve to aggressively raise interest rates and break what he calls the inflation mentality. Zell spoke with Carlyle co-founder and Bloomberg TV host David Rubenstein.
I also think that interest rates could go up a couple hundred basis points and not throw us in a recession, because I think that there's been just so much capital splashing around that I think, the first kind of major swallows of reducing the excess flow, I don't think are going to have quite the impact that the stock market is reflecting.
And you can watch all of that exclusive interview with real estate titan Sam Zell tonight at 9 p.m. New York time on Bloomberg Wealth with David Rubenstein. In Shanghai, there are fears the city is heading back into lockdown a little more than 5 weeks after exiting a 2-month ordeal. The city reported 59 new coronavirus cases on Monday. That is the 4th day in a row that case numbers have been above 50. The detection of a new substrain of the Omicron variant triggered 2 more rounds of mass testing in Shanghai. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rita Gupta. This is Bloomberg.
It's the combination of the withdrawal of liquidity and the increase of interest rates, which I think is starting to bother financial markets. My bet would be that at some point in the next few months, maybe even next few weeks, we are heading for some kind of a financial accident.
Michael Scholl, Market Field Asset Management, really quite strong yesterday, I thought. Lisa, I thought it was really good how he pulled it back to focus on Europe.
Yeah, and that seems to be definitely the theme today with the parity watch hysteria that also is just bleeding into a general fear of European equities.
The general fear 2 hours ago was more general and more fearful than it is right now. There's a little bit of an improvement here. I could start at any item of data. Just to say red and green on the screen, NASDAQ even slightly green as well. With a chart, Kriti Gupta.
Well, Tom, we got to talk about that currency story, but in the perspective of the stock market, because of course we see that dollar strength. Well, it's weighing on the euro, it's weighing on the yen, really becoming a weakness around the world kind of story. But in the stock market, it shows up a little differently. In fact, if you're a foreign investor in the stock market, you're actually outperforming anyone who's holding it in dollars. And that's really what my chart of the day shows. It shows you the S&P 500 in blue. For our radio audience, stick with me, and the S&P 500 in dollar adjusted terms. And what you're going to see is that in the last year, if you adjust for the dollar, your portfolio, you're holding on the S&P 500, well, it's flat, even counting that year-to-date loss that you've seen. If you're holding it, however, via the dollar, then you are actually seeing your losses eroded to the tune of about down 12% in the last year. So once again, it really speaks to that currency story, just how much of the dollar story is holding you back if you are a local investor in the stock market.
And it speaks to the EM market weakness that we've seen, down 47% in the last 10 years as well. Right now, when B. Ritholtz stops by, of course, with an important podcast and writing, always thinking about these markets. And Barry, I want to dovetail your recession analysis and your upset at the media's hysteria over 2 quarters with the idea that 2 quarters with the idea of the earnings season upon us, where we have a quarterly earnings frenzy. How do you dance the quarterly earnings ballet constructively?
Well, a couple of things. First, historically, the analyst community tends to overestimate earnings, except in the depths of recessions where they underestimate them. They miss the turnaround. But that said, we've been at record earnings for 2 years. You know, the pandemic was very, very good for earnings. Give the American people $5 trillion in stimulus, and they'll go out and spend it, and it works its way to the bottom line.
American Airlines 2 hours ago out with 12% revenue growth, blah, blah, blah. Obviously,
12%?
Inflation kicked.
That's giant.
Inflation kicked. How do you adjust for this new inflation we have to figure out which company is going to deliver persistent free cash flow?
So here's the crazy thing about inflation and stocks. You know, inflation isn't selective. It cuts across the board. It hits everything. And so there's lots and lots of evidence that not only are companies passing along price increases given constrained supplies to the consumer, but the consumers have more or less been willingly paying it. And that seems to not have a negative impact on revenue and not have a negative impact on profits. If companies can pass this along, it shouldn't have too big an impact on the bottom line. And that's why, surprising to a lot of people, stocks tend to be a pretty decent hedge on inflation.
So, Barry, given that, do you think that this is a time to be more aggressive than people are currently at least expressing in their bearishness?
So here's the question. Whether or not we get a recession in 2023, I don't even want to talk about 2024. It's hard to see the current environment as being recessionary given job increases, wage increases, consumer spending increases. How much of additional tightening is already reflected in the market dropping about 20% year to date? And how much further is the Fed going to go in order to tamp down inflation? Remember, the CPI report that we're going to get tomorrow is backward looking. Lots of evidence suggests that we're already substantially past peak inflation. I don't know if it's in the June CPI report we get tomorrow or the July CPI report we'll get in August, but I don't think the Fed should be looking at 75 basis points unless they want to cause a recession. They should be looking at 50, which means that we're probably 2/3 through this sell-off. And if you want to start legging into equities here with the understanding that this may not be the bottom, there may be more to go, do it in chunks. That's how you get aggressive. You start buying here on the expectation, hey, maybe we end up down 25 or 30%, but the economy is too strong to see an appreciably worse market from there.
Given the strength that you hear about and that you're talking about, how much can you still count on bonds as a buffer at a time when duration seems to be the consensus bet?
That's a really fascinating question. Look, we're coming off a 40-year bond bull market where bonds did nothing but go up and rates did nothing but go down. Now the question is, how high are bond yields going to go before they start to becoming more attractive to investors? So if you could eventually see a 3% stable yield on the 10-year, I think that's where bonds are a buy. But, you know, right now there's a lot of volatility and a lot of uncertainty. I hate that word, but we don't know if the Fed is going to have a policy mistake or if they're going to engineer a soft landing, and that's the answer to your bond question.
We got to get back to the markets. One more question, Barry Ritholtz. The idea the corporation should buy back shares when things are lousy. Are we here?
So the problem is that too many corporations, you know, they're price chasers and they're buyers when things are good. It's rare in the depths of an 0809, right, that we see that. If you want to engage in increasing shareholder yield and you want to raise your dividend and buy back stocks, down 25%, certainly a good place to start, assuming your cash flow supports it. Absolutely.
Barry Reynolds, thank you so much. Lisa, we've got to summarize where we are right now. I would summarize it. It's more constructive than it was 2 hours ago.
And that seems to be a theme, at least in these early hours, that overnight things get disruptive. And I wonder how much that ends up being a liquidity story at a time when we just had the lowest volume of treasuries trade going back to December. How much is that kind of what's whipsawing markets overnight that then calibrate and stabilize when people finally come to the office in New York?
I think of everything on the screen, what we've covered it today, but oil is just, it's amazing that drop we saw in oil 2 hours ago.
Especially considering the OPEC report. I mean, OPEC put out its first report of the year talking about the outlook for the year ahead, saying that supplies are not going to meet demand, even with the expectation for demand to cool off a little bit in the face of some of these things. And oil is still down. I mean, how much is this a China story? How much is this basically just a positioning on the futures, not the physical market trading? I don't know.
Lisa, we mentioned the 3M deer fly repellent earlier. We set off a firestorm of analysis on Twitter as well. A firestorm, I say.
I'm looking forward to the welts. I'm hoping to avoid them. That definitely is welcome. As we talk about vacation plans, though, we can't lose sight of the fact that a lot of people are not leaving to go on vacation because these markets are so tumultuous.
Oh, that was a very nice segue there.
Thanks, I tried.
Some of the deer
Let's get back to the markets, not deer flies.
North of Old Forge, they've got wingspans like the B-52s at Camp Drum.
Think about this. Really, why do you keep going back to it? They're really the bane of
I can see you out there with one of those hats with a mesh around.
Oh, I love those.
Red and green on the screen. NASDAQ positive. I'm optimistic. This is Bloomberg.